data has turned, right? You're starting to see soft data, hard data, inflation data, all surprising to the downside.
For the US economy next year, we think that growth is going to stall in the second half. It's not a particularly great outlook.
I'm more worried about inflation coming back and a shock to the inflation trajectory than I am to the growth side of things.
The question into 2024 will be, can we stop the cooling before the economy tips into contraction?
Even though we have a recessionary call in the first half of the year, I think that's an optimistic scenario for the economy. It allows a reset.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get your week started live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly negative on the S&P. We're down by 0.25%. On the week last week, 5 weeks of gains on the S&P 500. This Monday morning, we're not finished with Friday. So let's talk about it. TK, if that was Chairman Powell pushback, this bond market absolutely steamrolled him.
You nailed it. It's not this finished Friday. I think it's a Monday that's starting sort of sleepy, pre-holiday and all the rest. The only thing anybody's talking about is Florida State. We'll get to that in a minute. John, you're absolutely right. We've carried forward the risk-on feel. Mohammed Al-Arian publishing out on Twitter in the hour a general risk-on feel or environment. I think he's dead on.
BMO's Ian Lincoln over the weekend saying this. Powell was more balanced than hawkish, Lisa, which given the current backdrop might as well be dovish. That's one explanation.
I literally have that quote right here because I read that and it was perfect. The other one was from Pantheon Economics. Chair Powell's heart is no longer in the optionality story. He repeated it Friday, but it's no longer realistic. We are all psychologists trying to analyze the mindset of Fed Chair Jay Powell.
You come in and you see the 10-year real yield below 2%, right now 2.02%. And the prints here, they're sort of nudgy this early in the morning. But John, we are moving at light speed. This November shock that we had continues. There's no other way to describe it. I like what, again, Al-Arian says this is just a complete risk-on moment.
And never mind last month on the month. Last week on the week, we had a 41 basis point move lower on 2-year yields. Off the back of some of the Fed speak, we push ahead to Friday. You've got payrolls on Friday. The estimate so far in our survey is 180,000. And we need to talk about jobs. And one name specifically, Spotify, TK. I put a pre-market a little bit early this morning. They're going to cut headcount by about 17%. Right. That's more than just a cut.
Okay, what's the similarity to General Motors? They're both facing a real yield. The answer is corporate executives. They have to shift now from the free money of the last X number of years. Spotify even mentions it in their comments. They're in a new financial regime that's for every company from Microsoft and AI success all the way down the food chain.
I always wonder how much this is going to be the popular excuse to cut jobs from here on out, talking about the economy. Sure, they still said that they're not immune to the fact that rates are going up and that the economy is slowing, but you have just as many companies who are saying we need to add a lot of very key tech people. So at what point is this signal and at what point is this noise at a company that has 10,000 employees and a lot of people have said need far fewer?
Got a little deal out there as well that we need to talk about, so let's do that. Alaska Air buying Hawaiian Holdings, TK. It's a $1.9 billion cash and debt deal. You can look at the move on Hawaiian, TK. You can quote that one. I think that's 181.
Yeah,
call it 182% higher. It's a tiny. You would say Teams win stock.
On radio, the decimal point is there. This is tiny, and I've flown both, and I think a lot of other people have on the junket from LA to whatever. But they're tiny, and I thought Steve Trent at Citigroup was really good on this in the middle of his note on the regulation and all that. I know we're going to have Helene Becker on later. Guess what? It's a 66% discount to other recent transactions looking at selected ratios. This is like desperation transaction.
I was just grateful that they're connecting the Ring of Fire. I went down a rabbit hole about the Ring of Fire and sort of this volcanic active.
Okay, I've got to explain that.
So basically, there is this entire circle in the world of volcanic action, and Alaska and Hawaii are both part of that. And there are a lot of similarities in the land. And I was very excited that they could get.
That's the rationale for the deal.
That's my rationale. I was excited to see that.
Okay, here's another deal potentially, and I stress potentially.
It's a CFA level 4.
Earlier this year, we had a massive deal for American Oil. Exxon, Pioneer, might get another one, a smaller one, from Oxy and Crown Rock. This according to people familiar with the matter. These two are in talks. Occidental's a little bit lower, Tom, down by about 0.5%. This would value Crown Rock potentially. I say potentially because there is no deal to talk of yet, just talks. But maybe a deal valued at more than $10 billion including debt.
Yes, the guys following private jets around. Where was it? Over the weekend, Saturday or so, they decided they saw the Oxyjet twice in Omaha.
Yeah.
Is a major shareholder of Occidental. I mean, Occidental, some good things here. They took out Anadarko. That was really, really successful. This is a very different transaction. There's a sidebar here of some Republican politics by the principal owner of Crown Rock. So, it's something to follow. But again, it's this roll-up. Is it a zombie roll-up? I don't think so. But energy, look at energy's underperformance in November.
This is how you stay competitive, TK.
Yeah.
You've got to get that scale, which is what Exxon and Pioneer are doing. We'll come back to that if we get some news for you. Let's start with the scores on the S&P 500. Slightly negative on the session. We're down by 0.2% on the S&P. We've got a reset in the bond market. I know yields are higher this morning by 5 basis points, but there it is. A 10-year, Lisa, 4.2433.
And when does it start to signal something negative for equities? We'll talk about that. This whole week, though, feels like a drumbeat to Friday, which is the drumbeat to the non-farm payrolls report. In labor market news, we get the October JOLTS report tomorrow. We get ADP, which no one cares about until they do on Wednesday. Thursday, initial jobless claims. And Friday, what is going to be the bigger surprise for markets if you get an upside or a downside surprise for the non-farm payrolls number? In central banking news, you both will be happy to know that the Fed is in a quiet period ahead of next week's meeting. We do have a couple of ECB speakers, including Christine Lagarde, today at 9 a.m. But really, the main thing is going to be the Bank of Canada in terms of central banking news on Wednesday, their rate decision. And to me, they've been a leader, actually. So I think that this could be telling in terms of where the balance of risks are.
I never know whether to take you seriously or not.
Well, Canada has been important recently.
Okay.
I'm just telling you that. It has.
Are we doing Canadian auctions later this week?
Consumer spending. Tuesday, we get ISM services. Thursday, change in household net worth and consumer credit. Friday, the University of Michigan sentiment survey. Michigan, up there, Canada.
When I first moved here, about 8 years ago.
You thought Michigan was in Canada.
Wait, no. I would say things like, should we cover the Canadian data and the central bank decision? And I was told by a bunch of Americans, no, we don't care about Canada. We don't care about Canada. And that was my takeaway.
I'll be honest.
We don't care about Canada.
Nobody cared about Canada.
They do now?
Except that they recently have looked at it as actually a leading indicator. I'm not saying it will be. It's a quiet week on central bank front. I thought you guys would be happy to hear that.
We got to get to our extinguished guest here, but we can go into Canada later why it matters. It matters.
Do you want to do Bama and FSU now?
No, I think we should wait. I mean,
I don't get how you can go unbeaten the whole season and not get in the playoffs.
It's a disgrace.
Because there's a committee that decides that another team is better.
I was watching London football, seriously, and you guys are watching Bama.
No, I'm just saying, I get all these complaints about European football. I don't understand the rules, all of this stuff. And then I find out in college football, there is a committee that can decide that even if you are unbeaten for the season, there's another team that's better than you, so decides the place. I get it. Bama beat Georgia, TK, and that's a big win. You win the SEC title and all of that good stuff.
I thought Chuck Todd over at NBC was very eloquent on this. He's a Georgia fellow and is steeped in it. And it's an absolute outrage.
It's kind of bizarre, right?
There's no other way to put it.
More on that a little bit later. Joining us now is Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony Dwyer with nothing to sell. Tony, you say this, and I think it's interesting, it's refreshing. The big call for us going into year end is there is no big call to make. Tony, just explain that a little bit more.
Well, the title of the note was Chillax. So when you look at the kitchen behind me, that comes from my teenagers used to come in and they do something that they thought was fine and I thought was outrageous. And they would say, would you chill out or would you relax? And so we got the family thing of chillax. And I think that's what investors need to do after the markets had this. It was an identifiable catalyst off that October 27th market. You had an extreme historic oversold condition coupled with, real catalyst. You had a bond market, unlike today, spiking to 5% on the 10-year with a Treasury refunding coming up, a Fed meeting coming up, and a payroll data point coming up all in the same week. But the move we've had has pretty much met the parameters of what happens in the fourth quarter of a pre-election year, what happens after 3 negative consecutive months of August, September, October. So we've had the great rally, and now it's just kind of a chillax.
What do you make of the fact that, yes, you might be saying chillax, but a lot of this has been driven by the bond market and people are hearing what they want to hear and psychoanalyzing what Jay Powell really means rather than what he's actually saying?
Lisa, a month ago, the bears are totally right. The bond market was telling you inflation's going to spike and the economy's too hot. And that was wrong. So am I supposed to now believe, because the bond market's collapsing in terms of yield, that that's telling us that something's correct? I think the problem in the marketplace here is the market has a move. Kind of we get the tail moves us so that we have a narrative that's now based on the move when the prior moves were wrong. So I think your word psychoanalysis is great. It's been my belief this entire year. I have not changed our view that we're going to see a recession. And at some point, which I think we're at that point, inflation's not the problem. The core PCE peaked in February of 2022. So it's accelerating to the downside. Inflation's not the problem. Earnings growth and economic activity, I think, is the problem.
Tony, your arch call as a recession means get out of stocks. How do you actually execute that call? Do you have to wait for an NBER recession? How do you declare Dwyer recession so you go sell Microsoft or Apple or whatever?
Well, we have to define the market, Tom. Again, I know we talk too much, these stupid sayings we have, Mag 7, whatever they are. The top 10 stocks currently account for about 35% of the S&P 500, which is it's a historic level of concentration in the marketplace. So to say that, when you say sell the market or buy the market, I think it's very important for people like me to categorize what they're exactly talking about. In a world where on October 27th, you had the Russell 2000 down 33% from peak and the KBW Bank Stock Index down 51% from peak, that is discounting some degree of a recession already. Obviously, the top 10 stocks are not. So at this point, a recession would be a further worsening in the unemployment rate. I think we're there. The Salm rule hasn't kicked in yet. But, my buddy Darda over at MKM has a good one where within 9 months of the cycle low, if you've moved up to 0.5%, you're in a recession. So I think the whole positive story here, Tom, has been about the consumer's okay because employment is full. If it's not, that story changes.
Well, let's channel Michael Darter here because his dogs are very chillax. There's no question about that. Tony Dwyer, I want to look at Darter's look at nominal GDP, which goes right into revenue growth. Are you looking for subpar revenue growth as a driver to tepid stocks given recession?
I am, and we have been. I think it's very unlikely we're going to get to that 245 number that's out there for consensus for S&P operating profits next year. So that if you look at the actual trajectory of revenue, it's coming down. We're still at a double-digit margin. But again, that's because of the top 10 stocks. Last August, when inflation's ramping, the Fed's doing 75 basis points at a clip, and everybody got bullish, that was the time to be super negative. Now it's the time where we're looking for the opportunities because the average stock has gotten so beaten up throughout the last 2 years that a significant sustainable drop in yields is the only thing that we can see that'll kill the zombie.
Tony, I've got to squeeze this in. Gold, 21.35. in today's session, pulled back since then. But what is gold picking up the scent of?
Gold is the worst thing I'm calling. So I'm horrible at gold because to me, unless you hit somebody in the head with it, I don't know what you can do with it. It's not like you can shave off things and spend money with it, but it is absolutely caught in a bid. Every technician in the world sees the breakout to a new high. It's clear. What we've found is that momentum can continue. Typically when I wouldn't chase it, but again, like I said, I'm just not good. I've seen the gold move in different directions based on interest rates and based on currency moves. Yeah. So it's very difficult to really ascertain, like it's telling me something. I'm very cautious about the markets telling me something. What was it telling us October 27th in stocks? Right. What's it telling us now? And at the end of the day, I think we just have to, once you've had a big move, chillax. Get the data and wait for that next extreme for the next move.
We're so chill, Tony. Tony Dwyer of Canaccord Genuity. Tony, appreciate it, buddy. Thank you. Got some headlines dropping across the Bloomberg on Spotify. Those headlines are written by the class of 2023 over at McKinsey. They're going to optimize office space. Optimize. We can talk about those headlines in a moment. Spotify still positive, 1.67% from New York City this morning. Good morning.
Tuesday, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter. about the state of private markets, recession risk in the new year, and deal-making amid high interest rates. It's all happening December 5th, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
I want to make it clear, the right number of civilian casualties is 0. And clearly many thousands have been killed and many more thousands have been wounded, and now more than 1 million are internally displaced. We're aware of that, and we know that all of that is a tragedy. We grieve with all those families. That's why we continue to work, as Secretary Austin said, with our Israeli counterparts to get them to be as careful and as precise and as deliberate in their targeting as possible.
That was John Kirby, the US National Security Council spokesperson, speaking on Face the Nation on CBS over the weekend. It's a subtle shift of emphasis over the weekend by this administration. This quote here by the Vice President of the United States, Kamala Harris. President Biden and I have also been clear with the Israeli government in public and in private many times. As Israel defends itself, it matters how. This quote goes on to read the following. The United States is unequivocal. International humanitarian law must be respected. Too many innocent Palestinians have been killed. Frankly, Tom, the scale of civilian suffering and the images and videos coming from Gaza are devastating.
It increased over the weekend. I was absolutely thunderstruck by the shift, a massive shift, John, from previous weekends when we sort of, stop our business world and focus on this tragedy. What I did is I got out the map. That's what I end up doing on this. It's back to my childhood. You got a 24-mile coastline, and Lisa, I'm not really sure I understand the geography, the demography of North and South Gaza around the pregnant question. Okay, push them south. Where do they go? Into the sea?
Well,
I don't know.
A roving kind of target as they drop leaflets. There's a question here also of whether there are talks about an additional pause in fighting. The U.S. evidently is trying to double down and reignite some of those talks between Hamas and Israel. Again, though, to me, it feels like nothing is getting that resolved. And the bigger question now is, what is the ultimate goal? And how clearly does Israel need to
I think they've
stated
their ultimate goal. I think Israel, I saw a number of headlines in the Zeitgeist, which is they look at this to be a long event. I'm not sure what that means, John. And to me, what they're also doing is they're speaking to the U.S. and to our allies about their belief. And over the weekend, it was harsh.
I think we have to preface every single conversation about this with the following. This is so complicated. Yeah. So there is always a risk of oversimplifying things. The objectives for Israel haven't changed. We'll be clear about one. Two, the emphasis has shifted from this administration because of the division, apparent division within the government, within the administration, between the State Department, without a doubt,
absolutely,
and within the political party and the party in Congress. So you see that shift of emphasis in the language from Kamala Harris, Tom, over the weekend. And also the talk of a post-war Gaza, what that looks like, how many resources we need and what needs to be strengthened after you've destroyed Hamas, if you can destroy Hamas. So, TK, where do you begin, where do you end? I think we have to begin with a shift in emphasis by this administration, this White House, over the weekend.
Our shift is to talk to people well informed on this. We are thrilled to bring in Julie Norman. The title is co-director of UCL Center on U.S. Politics, but all of our academics is on the incredibly difficult idea of terrorism. Julie, is Hamas still a viable terrorist organization?
Well, Tom, Israel is obviously trying to debilitate Hamas militarily. They have said they want to oust Hamas completely. I think, as many others have pointed out throughout this conflict, Hamas is very much a resistance movement. They're also a political party. They also have their armed wing that carried out the attacks on October 7th, as well as other attacks throughout the last several decades. So they still operate in many forms. And I think even if their military capacity is debilitated, much of what motivates many of their members and motivates much of armed resistance will still continue. And that's something that Israel is going to have to grapple with, and something that the U.S. is reminding them of in trying to think ahead to the day after and what some kind of end game might be.
The end game, I'm not even there yet. I'm just trying to get through the weekend as well. Please interpret for our viewers and listeners how we move on from the atrocious headlines of the weekend. Where are we in 7 days?
Yeah, I think this next several days and weeks are going to be very, very decisive and very difficult. For the last, for the previous weeks, we've seen a very intensive incursion into the north of Gaza, and many civilians, over 1.5 million, were told to flee to the south of Gaza, which most of them did. this next wave of the incursion that we're expecting will take place in that South Gaza area where people have already relocated. There was messaging to civilians over the weekend to move out of certain areas, but many people don't have access to those messages. Much of it was very confusing, and it's really just not clear where people can or should go without being targeted. So I think for Gazans and civilians right now, this is an extremely difficult time, and the operation for Israel's defense forces, if they move forward with what seems to be planned, will also be very difficult operating this kind of situation.
I want to pick up on what John was talking about, the subtle shift in tone from the administration. We've been hearing the evolution of this over the past couple of weeks in response to a lot of pushback from within the administration. How material do you think that shift is in terms of policy?
Yeah, it's a good question because we've heard actually this messaging from the White House almost from the week or two after the attacks. It was a bit more subtle at first, a bit more behind closed doors, and has become increasingly public. What I will say is, though, those initial calls for restraint from defense, from the White House, were not really taken into account in the initial phase of the incursion in the north. And it's really unclear if they will have an effect in this next incursion in the south. And I'm not even sure if Washington is aware of how much leverage they do or do not have with Israel on this. And as we pointed out, there's been a lot of change in talk, but in terms of actual real policy, in terms of support for Israel, that remains very strong from this administration and from the White House. And I don't see that changing right in the near future.
On the flip side, what's the message from the fact that we have not seen a major incursion from Hezbollah? Yes, the Houthis sent that drone over that was shot down by U.S. warships, but hasn't materially gotten involved. What do you make of the fact that it has not escalated, despite some of the pretty fiery rhetoric around the Middle East?
Yeah, it is quite notable that the main focus of the armed confrontation has still been located within Gaza. That's not to say other things are not happening. Again, the northern border of Israel with Hezbollah has been very tense with cross-border firing. Obviously, we've seen escalations in the Red Sea and even attacks on U.S. presence in Iraq and elsewhere. So it's not that other things aren't happening. But what I do think is a very concerted effort from U.S., from the allies, and even from actors like Iran to not escalate this out of control. Iran and their proxies are doing things to show that they are part of this, to kind of be in the headlines to some degree, but they could be escalating this much more. I think they're aware of the U.S. deterrence measures that are there. The U.S. definitely has been clear in their messaging that if this gets out of control, they will lean into this very hard. So right now, I think the situation is still very tense. It could still spiral upwards, but there seems to be this consensus of let's try and keep the region as stable as possible and locate the crux of this conflict into where it's most located now in Gaza.
Julie, thank you for the update from you and the team. Julie Norman there of the UCL Centre on US Politics. I promised you an update on Spotify, some more headlines for you. The first headline, waking up this morning, Spotify to cut 17% of jobs. Now, cutting costs money. So this is what you hear from Spotify on that. They now see this, a 4Q operating loss of somewhere between 93 million to 108 million euros. They had seen a profit of 37. So that's a change. And it's not just jobs to go. Bramo, your favourite headline this morning, to optimise office space footprint.
Oh, yeah, I love that. Instead of just saying we're going to cut office space,
why won't they just say cut?
I don't understand this. We're going to optimize office space footprint in light of the eliminations of staff roles. I mean, honestly, how many ways can you say, look, we need to lower costs, we're going to cut staff, we're going to cut office space, and we'll look forward? And how much is this basically covering what otherwise had been a pretty disappointing quarter? Because otherwise, why would they come out and do this?
The illusions to me, and this goes to streaming, which of course Paul Sweeney's expert on, is they've been giving away a free lunch for X number of years. And so they go, okay, we're going to raise the fee, and Disney's doing it and others, and they're going, the kids don't want to pay the raised fee, so they've got to completely readjust what they're doing.
Are you kidding? The kids don't care. The parents are the ones that are saying, we're not going to pay it for you.
I'm happy with Spotify. I'm happy with my Spotify.
Spotify's good.
Did you do your Spotify Wrapped? Why did they do that at the end of November? Why don't they wait until the end of the year?
Were you really into that? Were you like excited to see what?
I was excited to see, of course. Yeah.
My son was like very.
Was your one Clash?
I think it wasn't. I'll show you my top 5 in the break.
Mariah Carey.
I think it was 13,000 minutes for the year.
Mariah Carey,
something like that.
But was it mostly music?
Max Kettner, HSBC. Here's the note. Just the title. Goldilocks forever? ? We'll ask that question in a moment. Equities look like this. Here are your scores on the S&P 500. 5 weeks of gains on the S&P. Longest weekly winning streak going back to June. We're negative this morning to kick off potentially week 6. We're down about 0.25% on the S&P. On the Nasdaq 100, down 0.33%. The Nasdaq hasn't had a down week since October. Just about squeezed out a weekly gain off the back of Friday's rally. Off the back of a monster move in the bond market. Forget November, just focus on last week. The two-year on the week, down 41 basis points. It's up 6 this morning, 460.21. I said at the start of the programme, Bramo, if that was Chair Powell pushback, he got steamrolled by this bond market on Friday.
You quoted the Ian Lingen quote from BMO Capital Markets. It was more balanced than hawkish, which, given the current backdrop, might as well have been dovish. Basically, he gave a speech where he kind of tepidly said, we're still looking at balanced risks. And people said, your heart just isn't in it. We don't believe you, and we're going to move in the other direction. And now we're looking at a 50% chance of a rate cut come March. 50% chance priced into the market.
We're going to get to it with a good guest here, but the basic idea is just the Newtonian math of this, and the answer is we're getting weaker inflation faster, not only here, John, but in Europe as well. If this was just the U.S., I'd say okay, but I'm sorry, this thing feels global.
I would say that was what was odd about the move elsewhere. And you have to have the other side of the trade in the FX market to understand it. Even with that move that you saw in bonds, foreign exchange looks like this. The euro was the weaker currency on the week against the dollar, 108.78, because we had a big downside surprise on CPI, Tom, in Europe. Inflation lower. And there's a conversation now about rate cuts from the ECB and maybe the ECB coming before the Federal Reserve.
I'm going to go back to nominal GDP, and I don't know what it's going to do for the dollar. Everybody's got their own opinion on the dollar, but I'm just looking at this global slowdown that everybody's modeling in, and for some way, a global slowdown is beneficial, stocks up. I'm like, okay, that I guess.
Goldilocks forever, Tom.
That makes sense.
Further disinflation. This is Max Kettner. Low near-term growth expectations. Investor sentiment subdued. Lisa, that equals apparently HSBC. Goldilocks. The forever piece of it, I'm not sure they're on board with that just yet. I think that's just to get us to read it, right?
Well, okay, let's just be very clear. So the whole thing, the point of it, Goldilocks forever, parentheses, question mark. And so then they really dive into that question mark where they say basically nobody is expecting the Fed or any of the other policymakers to cut rates 6 times next year, but no one is willing to push back against it. So his comment is it time to push back against it now, or is it just too early? So he's kind of being, a little snarky.
He's being cute.
I'm sitting there on a Sunday afternoon having a beverage of my choice, and John calls me up hysterical about Florida State. So we're talking about Florida State. And I mentioned him, I said, Bank of America Derivatives had out this great chart that within all the dynamics that we've got, there isn't like an overbought effervescence. There isn't Greenspan's exuberance here right now.
What's that got to do with Florida State?
It didn't. We had to switch gears. So we had to calm you down. So we talked derivative math.
Okay. I thought you were going to make this anyway. Under surveillance this morning.
Please.
Your update. Israel expanding its military operation against Hamas, striking targets in southern Gaza with another ground invasion expected. This as the U.S. Navy responded to a number of attacks against commercial ships operating in the Red Sea. No casualties were reported. Lisa, but the U.S. said rebels backed by Iran were to blame.
And this goes to what we were talking about with Julie Norman, that we do see tensions continuing to escalate. The military presence on both sides of Lebanon and Israel's border has been increasing. And yet it's all been tit for tat, not trying to push things too far to become too much of an escalation. That to me is telling. Do we see a shift in that, or is this just going to kind of grind out with the political sphere really being dominated by just popular opinion more than anything else?
AMH joining us in about 45 minutes from Washington, D.C.
Gotta wake up.
Anne-Marie just around the corner. I think she's got out of bed now, TK.
Okay.
Washington hours. 6:30 is incredibly early for someone living in Washington. Let's be clear about that. Got some deal news to talk about. Shares of Hawaiian Airlines up more than 100% in the pre-market after Alaska Air agreed to buy the company in a $1.9 billion deal. Alaska saying the two airlines overlap on just 12 routes, or 3% of their total seats, and will continue to operate under their own brands. Alaska's CFO calling the deal, quote, pro-competitive and pro-consumers. I think, Tom, that's a Dear Regulator letter.
Yeah, it's a massage, and it's about the regulation. We haven't talked about that yet, but this is an administration that has said to the airline business, enough. This has sort of got all sorts of asterisks around it where maybe somebody blesses it. but a lot of the research notes say it's going to be a tough battle.
When hasn't there been an acquisition where the other side turns around and says it's pro-competitive and pro-consumer?
I know. That's basically, you're right, dear regulators. I will say this, though. Do you know that in Alaska, there are more people with pilot's license to sort of ride those planes than there are with driver's license?
Between islands?
Yeah,
This
because,
is
I mean,
Grandma.
both of the
I
places,
didn't know that.
John,
but
you
both
ready?
of these places
This
really
is
are
Grandma
dominated.
war stories. It's like when she went to Greenland like
Yeah,
6 months.
right.
Give us a war
Just a jump
story on
between
Alaska.
islands.
Yes, but it's puddle jumping. It's sort of like, instead of having a car, instead of having a
didn't know
boat,
that.
you have a little prop plane.
Have you
and a
seen
lot of
like
them are
polar
older.
bears? Have you like been out in the tundra?
If
and
Tom had
actually
said that, I
seen
wouldn't have believed him.
polar
But because
bears?
it's
No,
you,
it's true.
I believe you.
It's actually the way to travel around. So it just sort of shows the importance to the ecosystem.
Breaking news, Bramo. The way to
of the
travel
airline
private planes.
Situation.
The way to travel.
She's got the
They're
LLB
prop planes.
boots that go right up to your knee in case a snake
Let's just
bites
move
it
on.
up.
We want to get you two pieces of price action, okay? Expectations for Fed rate cuts, fueling big gains in both gold and Bitcoin. Gold touching a
To the
record
moon.
2,100 overnight before pairing most of those gains. Bitcoin topping 41K, taking its year-to-date gain to 152%. Investors increasingly convinced the Fed will begin cutting rates early next year. Even as Fed Chair Jay Powell said Friday this, it would be premature to conclude with confidence that we've achieved a sufficiently restrictive stance or to speculate on when policy might ease. Yeah, selective hearing in the bond market, TK, through all of last week.
And BitDog really beginning to move here, and I guess some of it's ETF effervescence. Bloomberg's got a real cottage industry on that. But the trade here nobody's talking about is off of COVID. Dennis Gartman up 72% in gold when you hedge it against Japanese yen. To me, it's not NVIDIA, but stupid gold is up 72% off the pandemic gloom.
I love Tony Dwyer's honesty. He's like, I don't get it.
Yeah.
Because people, and I agree, because I was looking at what was driving this. I'm thinking, okay, does this mean inflation? Is this like an inflation call? Is this a slower growth call? And in reality, some people were saying it's because if you get less from your cash, you might be less inclined to invest in cash with interest producing revenues versus gold. You're looking at me like I'm nuts, but it's true. I mean, what rationale can people come around to explain this move?
Okay.
24 years old in a meeting with John Templeton.
Yeah, exactly.
I was 24 once. I know you don't believe that.
Thank you for trying
TK's telling stories. Carry on, please.
24, I'm in a meeting with John Templeton, and he channeled Tony Dwyer. Sir John Templeton said, gold, I don't get it. Which is,
He could be honest,
some
Tom.
good company. Dwyer, Templeton, I mean, it's good company. It's all there is to it. We're in good company right now on FX. George Saravelos is global head of FX research at Deutsche Bank. George, throughout your note, there's this speed towards very weak inflation, an abrupt disinflation. How do we play that in foreign exchange?
So I think, Tom, next year it's all going to be about these policy gaps. Which central bank is going to cut first and which one is going to lag, or is it all going to be symmetric? And the way I think we're being set up for next year is that the ECB is most likely to go first. If we look at the most recent inflation data, I would argue the ECB should actually be cutting next week. Core inflation over the last 3 months is running below 1%. So we're not that far away from having to start thinking about deflation risks when we're discussing Europe. And of course, the economy is also at best in stagnation. So I would argue the market is right to price more ECB easing, but perhaps versus the US is getting quite ahead of itself.
George, you've got some aggressive calls on both central banks now then. You've got a call on the Federal Reserve, you and a team. I think 170 basis points, 175 basis points of cuts starting in June next year. Now, George, there's a range of forecasts, as you know, for next year, but that's certainly not consensus. Can you explain to us all why you think we start in June but go a whole lot deeper than a lot of people think?
Well, I think, John, that goes back to the recession versus soft landing debate. And now, if you look at what the market's pricing at the moment, we have Fed funds going to around reasonable estimates of neutral, slightly above 3%. So the market is perfectly priced for a soft landing, so to speak. So I think if we're looking at next year, the strongest view I would probably have is this bond equity correlation, which has been very positive. So you've had higher bond prices and higher equities at the same time. That's very unlikely to last because you're either into a soft landing and therefore you can't price lower Fed funds anymore. Risk can continue going well. But if you do go into recession, then you can most certainly price more cuts, but it's not going to be possible for equities to still rally. So the last 3-4 months have been great from an asset perspective because you've had this bonds and equities going up at the same time. I think that's going to be very difficult to repeat itself for next year.
That's on the U.S. side. I want to just get you to elaborate a little bit when you're talking about your belief that the ECB should cut next week, that you think that the Eurozone is facing deflation and that risk is rising. What do you think will be the follow-on response if the ECB goes ahead and does that? Do you think that they could then engineer a soft landing, or do you think that they could just avoid the depths of a pretty significant downturn that you think hasn't been fully recognized?
So I think it's important to distinguish between growth and inflation. And in fact, if I look at Europe, I would say it's the perfect definition of a soft landing, because what you have is growth has slowed down, and at the moment it's around 0. So we're debating maybe we get 1 or 2 quarters of negative GDP. But as long as the ECB cuts, and I need to be careful in what I say, I think they should be cutting next week. I don't think they will. I think it's more likely precisely because they were late on the way in, so to speak, they'll be late on the way out. But as long as the ECB, say, cuts by March, April, I think actually Europe's going to be in a relatively okay place where the economy soft lands and inflation comes back down to 2% or potentially below. But that's actually a pretty good outcome. It's also quite a negative outcome for the exchange rate. But given how quickly inflation's coming down, probably a weaker euro is not a bad thing for Europe at the moment.
George, over the weekend was a lot of zeitgeist hope and prayer of a strong yen off of some form of policy change in Japan, a way for people to make big figures fast. Do you buy it?
So there's 2 ways to get a strong yen. One is that the Bank of Japan finally starts a proper hiking cycle. And what I mean by that is they say they're going to start hiking every meeting. That looks pretty unlikely, especially as the rest of the world is moving into an easing cycle. So I'd probably say that's the least likely outcome. But if you are in an environment where the other central banks are starting to cut because inflation has come down, then you can get yen strength because it will be the outlier, so to speak, on the way out as it was on the way in. So I'd be much more inclined to think about yen strength from the global perspective rather than the domestic Japanese perspective.
Dear Christine, George thinks you will cut next week. What do you think, George? No, don't worry. That's not going to be the headline. George Saravelis at Deutsche Bank. George, thank you. There's a difference between, I guess, will and should. And yes, ultimately, DB think they could and should cut next week, but won't. Ultimately, that'll come next year.
This is the should and could and maybe part of the show.
But the fact that he said that even if they do it by March or April, they're still in line to orchestrate some sort of soft landing, which raises this question, which economy is going to outperform? Europe or the U.S.? Everyone just assumes it's going to be the U.S. because of technology.
I was just going back and forth with Dr. Ilarian, and I was reminding him of the Bank of Japan abject failure somewhere in the middle 2000s where they tried to raise rates and had to go, oops.
When we say
it's the same thing here, cut
outperform,
rates, oops.
Absolute terms or relative to expectations?
It's a good question. Relative to expectations would affect market positioning, maybe. In absolute terms, I'm guessing that's going to be tough, given the tech outperformance in the U.S.
Because relative to expectations, the economy, that's already happening, isn't it? The surprise indices.
Yes,
you look at what's happening with the U.S., great disappointment relative to where we were maybe just a few months ago in the States.
But this is what I think a lot of people have attributed to why the euro has outperformed, at least in the month of November, why it did rise as much as it did versus the dollar, even though there was this everything rally in the United States. It wasn't just a sort of a rate differential, but it was also the European economic data was coming in better than expected. The disinflation was happening faster than expected. You know, going into next year, how much is this sort of set up to repeat, given what people's expectations are?
I don't have a strong opinion. I just think November's a shock, and we're starting right in on a November continuing here.
Yeah.
And to me, that's the heart of the matter.
I saw someone write this weekend that I think the outlooks for December, looking out 12 months, are basically just taking November and extrapolating current trends out. Right, that's kind of
what
like the
outlook. What else can they do? I feel for that.
We reset in Q1, which is what we always seem to do.
How else can we do this?
Every year. Equities negative on the S&P from New York City. A beautiful morning in New York City.
Oh.
Good morning.
It's all about the human condition. More people are living longer. We've cut childhood death in half. Climate is this negative thing that's slowing down that progress. And so In mitigation, we want to make sure the temperature doesn't get too high. And then in adaptation, we want to make sure that the ill effects, that whatever we can't mitigate, that it doesn't reverse this incredible rate of human improvement.
That was Bill Gates there, the co-chair of the Bill and Melinda Gates Foundation, speaking with Bloomberg's Francine Lacqua on the sidelines of COP28. It's always on the sidelines. It's never kind of at the event. You notice that? It's always on, what does that mean?
It means
on the sidelines.
It's not necessarily on the panel.
It's on the sidelines.
Yeah, exactly.
Great piece in the Financial Times earlier on, TK. I know you've read this as well. The real impact of the ESG backlash in the Financial Times this morning.
This is Brooke and Tim, the duo over at the FT, Brooke Masters, really walking through it. They feature Larry Fink and BlackRock a lot on it, but it's fascinating to me to see the gathering of the great, the good, and the worthy in Dubai wrapped around what does it mean for climate finance. And at the minimum, it's in a massive turmoil right now, whatever anybody's view is.
Don't you get the feeling that there is a great majority, I would say not a great majority, a good slice of this electorate right now, Tom, in the United States, that look at what is happening in Dubai and see this gathering of what they see as the establishment, as elite liberals telling them how to live their lives after landing in private jets in the Middle East and flying thousands of miles to tell us all to consume less oil and fossil fuels.
Yeah, and their G6 is the Dierks Bentley song. What I would suggest is, and there's one chart in the FT article, the difference between Europe and America.
Oh, like massive.
We all know that, but massive.
Vast,
no, you're
huge,
right. Massive
huge.
is the operative word. It's huge, Lisa. I was stunned at the ESG investment impulse versus in America.
There's a new tone, though, I would say, and it's moving from the sort of highfalutin dreams and hopes and messaging and going more to the reality of it. And I think that is sort of what I felt a little bit more from the rhetoric and, frankly, some of the pledges, particularly from the oil-producing nations, OPEC plus, less so the oil-producing nation of the United States, ironically, that's been accelerating production.
Crude production, Tom, 13 million barrels plus a day in the United States of America.
And what will that be a campaign issue? I mean, it's going to be interesting to see, and particularly
we just
what the
don't
price
talk
of oil
about it.
does. We don't.
Seems to be the approach at the moment.
Talk about it. Right now, we are going to look at the climate affairs of Dubai, and this with the World Bank in transition. From David Malpass over to Mr. Rangan, what's so important here is his corporate work with Nestle and on MasterCard and then General Electric. With a conversation with the president of the World Bank, our Jen Zabajaja in Dubai. Jen?
Yeah, thanks so much, Tom. Ajay, Tom was just giving you a really great intro there about how your previous career, now you're at the World Bank. And let's just talk in the first few months of your role, you've made climate finance a priority. I mean, can you talk to us about where you've seen progress and whether you think this is really a turning point for this discussion?
I think it's very important because the reality is that we've had the hottest year on record. We're aiming for another hot year. Clearly, this has to change. And you can't make climate and fight the climate issue without money coming to work on it. So it's one of the most important things. When I traveled around the world, I picked up the impression that dealing with poverty cannot be by itself. You have to deal with climate, pandemics, fragility. These are all intertwined crises. That's why we changed our mission to include livable planet in addition to eradicating poverty. So this is what we're on. And what I'm trying to do here to show you the progress is to make a commitment that we will get to 45% of our financing annually will go to climate by 2025, 2 years from now, not 10 years from today.
Right.
That's $40 billion a year working on climate finance.
How do you do that? How do you adjust your balance sheet to ensure that?
Yeah, well, the good news is we're also raising capital along the way, thanks to this whole capital adequacy framework that the G20 got us going with. And we're also doing things like looking at whether we can securitize parts of our balance sheet, existing balance sheet, free up some capital, and then partnerships. So you don't really do all that financing yourself. You can also get partnerships going. I have great partners with the other multilateral banks, AIIB, EIB, EBRD. These are all people who work with us. So there's multiple ways to go at this. But at the end of the day, the much bigger issue here is, even if I do all that, even if the other multilateral banks do what they can, even if governments do all they can, you do need the private sector. You're going to need their ingenuity and technology and numbers.
Right, and that's what you've been spending the past few days talking a lot with the private sector. This is your first COP.
Yes.
Can you talk to us about, give us a sense of what it's like in the room, where there's consensus and where there's still gaps within the private sector and the collaboration between
That's a great question. So the private sector issue is the private sector now knows that solar and wind power per unit is cheaper than fossil fuel. That's proven with scale and technology. They know that it takes longer sometimes as a gestation period, and they know they may have some higher capex up front because they got to build grids, and you can't just build the installed capacity, right? So they understand that. So why is it then that they aren't burning down the doors of countries to go do this? It's for 2 or 3 reasons. One is, does the country have the capacity to absorb this kind of projects coming in? Can they connect the grids up? Can they do all that?
Right.
But second, and much more critical, is the 2 kinds of risks that private sector investors don't like, which they don't understand. They don't understand political risk, and they don't understand foreign exchange risk in the emerging markets. Now, political risk we can help with. We have this institution called MIGA, our guarantee agency. We've now got approval to use that for every multilateral development bank. They can use our back office to issue guarantees. This does political risk guarantees and then lays them off in the reinsurance market. We need to scale that. It's the FX risk. That's the much harder
Well,
one.
how do you get around that? Because that's not going away in a lot of emerging
No,
markets.
so in fact, people keep talking about local currency markets as the way to do it. The reality is developing a local currency market with the right depth and width to be able to do this well can take 5, 10 years. We don't really have 5 or 10 years.
Right.
So I think we have to find instruments like, could we do some local currency bond issuance that we subsidize the difference in cost through our balance sheet or our concessional financing? Can we do things with others where there's an institution called TCX, which was created to help take some of the FX risk in these markets? Can we scale them up? And so on and so forth. Can we do creative swaps where using our rating we get at a lower price than what the country would? Hard. FX risk is the hardest one.
Yeah, so then, Ajay, when we talk about the progress then at the end of COP28, your first COP, what does that look like for you? What is it that you're shooting for? Because there have been a number of initiatives and pledges.
Yes.
Of course, the World Bank has been a part of some of those.
Yes.
What then does progress look like in the next few days?
So I've got 5 very clear things I'm measuring on what we are doing. And the first one was getting that 45% of financing that we talked about. In that, 50% for mitigation, 50% for adaptation. So we don't only do emission avoidance, we also care about adapting and resilient infrastructure in the global south. I think that's very important. The second big one is methane. Methane is 80 times more toxic than carbon dioxide, but it only gets 2% of climate financing. So what we are doing is we've got actual projects on the ground on rice paddy cultivation, livestock management, and waste management. We're scaling those and saying we're going to get to 15 countries in 18 months, and over the course of these projects, take out 10 million tons of methane from the system. Third one is Africa. 600 million people in Africa don't have access to electricity.
Right.
We've got a project approved by our board, $5 billion of financing from IDA, our lowest price guarantee, kind of the cheapest fund location, 10 billion through governments and private sector. We're going to connect 100 million people in 7 years to power, solar power, including the grids that need to be existing to make this happen at scale. A fourth one is voluntary carbon markets. So I think the only way you transfer resources at scale from the developed world to the developing world, for what the developing world deserves to be paid for, which is forests and natural resources, is voluntary carbon markets.
But there's a lot of criticism about carbon markets.
Yes, there is, because people felt that the credits that were coming weren't genuine credits. So you just picked on exactly the topic that's really important. Verifiable, genuine credits of integrity are what determine whether these markets will work. So what I'm doing is I'm not doing a carbon market where I'm not involved. I'm doing carbon markets with projects where the World Bank is doing a forestry project in a country.
Right.
So we're starting with 4, going to 15 by the end of next year. We think these countries will generate 24 million credits next year itself, and 125 over 5 or 6 years. I'm certifying the environmental integrity through a jurisdictional audit, and I'm also certifying the social integrity, that most of the money they earn will go to the communities and the indigenous people in that area.
Right.
I think if you do things like that, and you do them with consistency, you will create the right kind of carbon markets for tomorrow.
Right.
Today, you're only getting $5 a credit.
Right.
Can't be
still,
right.
yes, but still a lot to go. But glad to have you here, Bloomberg. Ajay Banga with the World Bank. Ajay, thank you so much for your time. Thanks for joining us.
Thank you.
Here.
Thanks very much.
John, back to you.
Hey, Jen, thank you. We got to go. Jennifer Tabazaja there and Ajay Banga, the World Bank president. Coming up on this programme, on the market, Dan Morris of BNP Paribas. In the next hour, Helene Becker, airlines analyst on a potential tie-up here in America, and the busiest day ever in American airports.
The data has turned, right? You're starting to see soft data, hard data, inflation data, all surprising to the downside.
For the US economy next year, we think that growth is going to stall in the second half. It's not a particularly great outlook.
I'm more worried about inflation coming back and a shock to the inflation trajectory than I am to the growth side of things.
The question into 2024 will be, can we stop the cooling before the economy tips into contraction?
Even though we have a recessionary call in the first half of the year, I think that's an optimistic scenario for the economy. It allows a reset.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
5 weeks of gains on the S&P 500, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market this morning, session lows and down a third of 1% on the S&P. Forget this morning. Let's talk about Friday. Monster move in the bond market. On the week, 41 basis points lower on a 2-year maturity. TK, even with a bit of pushback from Chairman Powell.
Well, I like what you said in the previous hour. It continues this morning. Yeah, there's a little bit of a pushback in all that, but a 10-year real yield below 2%, right now 2.02%. It goes to my research note of this morning. Carl Weinberg at High Frequency Economics, a blistering note to Europe, as George Saravelis just talked about, deflation is possible.
The conclusion on the street right now for so many people is the Fed is done. That weekly move on a 2-year last week, Lisa, the biggest weekly move going back to March. Back in March, the conclusion was always the Fed is done. But also, it was the Fed is done for all the wrong reasons. They've broken something. Here we are about 6, 7, 8, 9, 10 months later, and we're talking about the Federal Reserve being done for all the right reasons.
And not only just done, right, with rate hikes, but actively cutting rates by March. The market is pricing in a better chance than not that they will be actively cutting rates, even though they're not expecting some sort of significant downturn, which raises a couple of questions. Is the global disinflation wave the same in the U.S. as it is, say, in Europe? And also, can we get that? Or are we going to see a rollover? Can you just chillax, like we heard earlier, and lean into this incredible rally and just say, hey, I'm going to take the rest of the year off?
Tell you what, so chill.
Oh, yeah.
It's so
chill.
It's so chill. This conversation about rate cuts is happening on a week. We're looking for this in a payrolls report. 180,000 is the median estimate in our survey. Tom, unemployment expected to stick at 3.9%. You've got a chairman saying we're well into restrictive territory. You've got a market pricing rate cuts. You've got a labour market that could still see 180,000 this Friday.
This is the second time you brought this up, and we haven't sat on it. Let's sit on it right now. I'm going to look at a 3-month moving average of non-farm payrolls. We're nowhere near labor slowdown, but there's a school of thought out there, I'd say led by David Kelly at J.P. Morgan, who make clear we could get there quickly. You get to a 3-month moving average non-farm payrolls under 100,000, or the negative non-farm payrolls that Dr. Kelly's talking about. That will change things fast.
Well, here's a company that is going negative. I don't know about the broader economy. Spotify, Lisa, cutting 17% of jobs. Leadership over at Spotify, looking for the streamer to be a whole lot leaner. Their stock is positive 0.7%.
Something like 1,500 people. They're also going to optimize their office space footprint, I believe. Basically trying to trim costs by reducing the amount of space they got to pay for at a time when they otherwise were facing some negative expectations. I mean, really, we have to emphasize this is coming with revenues that clearly were challenged.
Without a doubt. I think it always amazes me, at least, that to cut costs, it costs a lot of money, at least up front. Tom severances, it's not cheap. Cutting office space, getting away from those things costs money. So the new outlook for them, they've put a number on it, Tom. 4Q operating loss between 93 to 108 million. They had previously seen a profit of 37.
Two observations. They went out front with a 17% job cuts off of 6% and 2% previously. I think 6 plus 2 plus 17. Do the math. That's 25% jobs cut. They put it up front. GM buries it. I mean, six headlines down, GM's talking about $2 billion of cost cuts. There's no difference. They're cutting costs in a new world.
I'm pleased you're bringing up GM because I'm still a little bit confused as to what happened last week. And I became more confused once you hear more from Ford. So GM is saying off the back of the labour market contract, the labour contract they signed with UAW, the additional cost of $575 per vehicle. And Ford are coming out and saying it's upwards of $900. Now, forgive the pun, you can drive an F-150 through that range. That is massive, Bramo. That's massive. So have they been very, very transparent?
He's been here for 2 or 3 years, and he knows what an F-150 is.
2 or 3 years.
This is year 8.
Yeah, I know. But I agree with you. And there's some real questions here about the transparency around how these costs are to be distributed.
Let's move on and get the scores. Why do you always forget how long I've lived here for?
I don't know.
Come on. It's been a blast, TK. Equities on the S&P, down 0.4% on the S&P 500. Yields are positive by a couple of basis points, up 5, but still down here in the 420s. Lisa, 424.53 on a 10-year.
Today is basically just the beginning of a drumbeat to Friday with the jobs report, the non-farm jobs report coming out. Then we got October JOLTS report tomorrow, Wednesday ADP, Thursday initial jobless claims, Friday's jobs report. To me, the bigger question is what will the market respond more to, an upside surprise or a downside surprise? Meanwhile, central banks have gone quiet, except for 9 a.m. We're going to hear from ECB President Christine Lagarde. But at the Fed, they're quiet ahead of next week's meeting. We do get the Bank of England financial stability report. I am focused on the Bank of Canada. Their rate decision is on Wednesday. It's interesting in an otherwise quiet week to see whether they signal they lean into the idea of rate cuts as a result of disinflation, even without some sort of economic weakness. And consumer spending, we get to read ISM services tomorrow, Thursday change in household net worth for the U.S. as well as consumer credit, and Friday the University of Michigan sentiment survey. I want to see whether we see an ongoing uptick in the economic surprise index for the U.S. We've recently seen that shift a little bit. If it does, do people start to think, okay, well, maybe we are due for some sort of reacceleration in inflation that's being priced out?
Don't you think, and this is going to sound rude, that second-tier central banks have a little bit more flexibility than top-tier central banks? I mean, for the record, I put the Bank of England in there as well as a second-tier central bank. But
you know, what's interesting to me is that over the past couple of months, the Bank of Canada has actually been a front runner in terms of signaling how the mood is going to shift in other central banks.
Perhaps longer, yeah.
And there is a question, perhaps longer. So there is a question now. Is the sort of the backdrop of inflation diverging meaningfully between these different regions in a way where you can't necessarily look to these other central banks as tea leaves? I don't know the answer. I still think it's interesting to watch because there's not really any other central bank stuff to watch.
I'm on board.
Go for it.
Are we upsetting Canadians again this morning?
I've already gotten several messages.
It's a team effort.
I've gotten messages.
Okay. Dan Morris joins us now, Chief Market Strategist at BNP Paribas Asset Management. I hope not. And I hope he's still there. Dan's still there. Dan, let's get to it in the equity market. Massive move in stocks over the last month or so. Given the repositioning, given the rally, is the path of least resistance still for this rally to continue?
I think if we think, I guess from here, the two scenarios most likely, or I guess 3 scenarios ahead of us. So one, status quo, things don't change with this kind of perfect soft landing. That'd be nice. How likely we think that is. Alternatively, then, as Lisa's mentioned, it's either you get a blowout on non-farm payrolls or it's weak, and then how do the markets react? And in those scenarios, it's probably more risk to equities because if we get a weak number and instead of a soft landing, we start worrying about a recession, then equities aren't going to look so good. If conversely it's a very strong number, then at least some of this rally in real rates has got to come out, and that's going to hurt as well. So it does seem that the risk at this point seems more concentrated in equities.
Dan Morris, my arch COVID theme has been corporations will adapt. Right now, I think there's a disbelief that they will not adapt into 2024. I don't believe it. With the tentacles of BNP Paribas, how do you see how corporations will adapt to the new 2024?
Well, the thing I'd probably highlight in terms of the adaptability, I certainly agree, particularly when we talk about U.S. corporations, they will. Just go back to what happened during lockdowns. You had 20 million people lose their jobs during lockdowns. Now we know employment's higher than it was before. So you've seen that adaptability in extreme form then. So certainly they're going to try to anticipate what's going to happen. Our view still is for a soft landing. And I think that's the challenge for equity assets in particular, is being able to assess what's going to be a slowing growth environment, even if it's still, in the end, a positive growth number. that's tricky for equities. I mean, either you want things to be accelerating, that's easy, or even a recession is easy because we know how that works. This slowing growth is harder, and I think we're going to see those swings in sentiment as the market goes between a recession or it's just the Fed cutting sooner.
Dan, I want to just develop what you said a little bit more, that either way, equities face a pretty big risk on Friday. Are you basically saying that right now, equities are kind of priced to perfection in this Goldilocks sphere that can't continue, and that Friday is very well the catalyst to that, regardless of whether it's an upside or downside surprise?
Well, I guess you're looking what the next data point, big enough data point, is going to be that's going to upset the perception the market seems to be reflecting now. So we've got, basically a growth number we've already had so far, the ISM in manufacturing, which was weak, so that's feeding into the slowdown. But if we then get another weak growth number, then that's the risk that it goes towards a recession scenario. So that's the obvious one. We got to wait a while till we get more inflation data. So this is going to be the next key growth number, though at the same time, we want to remember labor market data is lagging. So how much this really tells us about what's going to happen over the next 3 months is questionable, but that doesn't necessarily mean the market won't react to it.
What do you think is more disruptive potentially to equities, an upside surprise or a downside surprise?
I think upside at this, if we get a stronger growth number and some of this rally in rates, particularly real rates reverses, I think that's certainly a reasonable scenario, but you wonder how far is that going to go? We've had a big rally, certainly in NASDAQ. That comes off a bit, but you're still obviously done very, very well this year. I think the bigger risk is to the downside if we start worrying about that recession scenario, because then the bottom probably is way slower than where we are right now, particularly after the rally.
Hey, Dan. It's good to hear from you. Dan Morris there of BNP Paribas. A slightly constructive view, nuanced, but constructive view going into next year. Canadians write in. Here's one. Bramo could give a relevance of Canadian economic indicators presentation on the Bloomberg of the Seas cruise while Ferro plans the Italian shore excursion. Is this cruise ever happening?
I think that people are planning it for us.
Can I just say, we've been laughing about cruise lines all year. And a cruise liner is the number 3 top performing stock on the S&P 500.
Yeah, it is
this year.
Plus, Royal something, I think, just put it. Somebody just dunked a new boat in the water, which is even bigger than the one you were on last sojourn.
Crazy.
It's like 42 floors tall.
Royal Caribbean cruises up 124% this year.
It's like on the edge of NVIDIA. Canada, the number one person I want to talk about in Canada is Jean Boivin at BlackRock. I think is just the guy that I'd really, and David Rosenberg, of course.
Would be so upset.
David Rosenberg in Toronto as well. And besides the fact, can the Bank of Canada bring back the Montreal Canadiens? The difference there is a good producing mining segment. It's different than America. And the other one I'd really focus on is a productivity differential. Canada, for generations, has had a productivity less efficient and surprisingly diminished from the United States efficiency. And those would be the two overlays that would be the difference.
Housing market really different well, yeah.
Way different.
Big difference there too. If you're just joining us, welcome to the programme. Here are the scores on the S&P 500.
Scores.
5 weeks of gains on the S&P coming into this week. We're pulling back just a touch. We're negative 0.4%. Yields are higher by 6 basis points. TK 425.49, but last week a whole lot lower across the curve.
Did you watch the Tots highlights?
I watched no football at all.
What is this about? This is
absolutely
this
no
is
football.
You?
I watched the Tots highlights.
Yeah, they're great.
They were really good.
Matt, thank you for emailing in or tweet, whatever. But it was really, Mohammed mentioned it.
Casa Bramo is all about Liverpool. TK,
what do you think of their
that.
kit? Kit leases their uniform.
They did really well too.
They get this
but
kit
Man
that's
City,
like this
they were versus
brown.
Man City, so you're kind of rooting for Tottenham because everybody hates Man City.
You watched 2 big games over the weekend.
I didn't watch them. I watched the highlights. I watched them the way that Tom Keene watches them.
Yeah,
let's just be very honest.
Right.
What you're saying is
I'm not
you
pretend.
didn't like the grey jerseys of.
They're not grey. They're like a pukey mauve kind of brown.
Would you like Daniel Levy's email address so you can?
No, I think you should re-interview the guy. That was a hugely successful interview.
We'd like to talk about your pukey moth-coloured jersey. Do you want to come on and have a conversation?
They look like they're
that's the pitch.
They look like a Dior roadshow in Paris or something.
Yes, John. When can I join?
When can I talk about that?
I'll get on the jet to New York. Okay. AMH is coming up shortly. Amber Reid down in Washington D.C. Just a bit of shift in the emphasis from this administration over the weekend regarding Israel. TK, some strong words from the Vice President.
A huge shift. No, I wouldn't say a bit of a shift. I'd say a huge shift in the news flow on Gaza.
That conversation, TK, is just around the corner. Your cross-asset price action looks like this. Stocks are pulling back. It's a reversal of last week. Last week, stocks up. This morning, stocks down. Last week, yields down. this morning. Yields up 6 basis points on a 10-year, 424.49. On a 2-year this morning, up 7. Back in the 460s. On a 2-year, 461. From New York City this morning, good morning.
Tuesday, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter, about the state of private markets, recession risk in the new year, and deal-making amid high interest rates. It's all happening December 5th, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
As Israel defends itself, it matters how. The United States is unequivocal. International humanitarian law must be respected. Too many innocent Palestinians have been killed. Frankly, the scale of civilian suffering and the images and videos coming from Gaza are devastating.
That was the Vice President Kamala Harris speaking at COP28 over the weekend. That first line, TK, really set it up. As Israel defends itself, it matters how. It's a shift in emphasis over the weekend.
A little shift in emphasis, but a real emphasis around the geography of moving north and south down 24 miles of coastline. We had video earlier, and I actually looked on the map. Okay, where's the video from? 4 miles from Rafah in the gate to Egypt, if you will. That horrific video we showed a previous hour, Good Morning on Bloomberg Radio, we're showing it on TV. That was, Lisa, 4.4 miles from that exit point into Egypt.
There was a lot of discussion around what strategic defeat meant, right? And I think it goes to this question of how, and also the imagery that's coming out, right? What is the devastation needed for Israel to achieve its goal? And how much is that going to be increasingly important for the U.S. administration and other allies? And how do you achieve that? There are increasing questions around what the influence of the U.S. is internally with Israel at a time where there's a lot of disagreement within Israel, not about the goal, but about how to get there and about what necessarily takes the place afterwards.
And tangential to this, besides American Navy and other forces at risk, was in the Red Sea over the weekend. Yemeni, I'm going to say drones, I'm speaking amateurly. On TV, we're showing the Khan Yunis Gaza Strip devastation for those on radio. But in the Red Sea, the United States of America is shooting, I believe, Yemeni drones out of thin air. I mean, you don't do that with a 12-gauge shotgun. There's a lot going on there.
Elise is picking up on another shift, Tom, and it's important. The United States and this administration want to talk about the end game here. What's next? We know the objective of the Israeli government, but it's the end game. And what you're hearing from Harris over the weekend is asking for significant resources from the international community to rebuild Gaza after all of this. And also, Tom, to try and strengthen the Palestinian Authority as well. And to get the support of the Palestinian people for the Palestinian Authority to lead the way here, Tom, and try and get some legitimacy from the international community.
I think you're dead on
These
here.
These are going to be big pushes.
And what we heard from the Vice President, the end game, and also a human rights-centric approach by a large part of the American force looking at this. Joining us now for a briefing on this, our Bloomberg Washington correspondent, Anne-Marie Horton. Anne-Marie, to John's point, I think he nailed it. There's almost two separate conversations going on. Enlighten us on what the Israeli conversation is this morning that Washington needs to listen to. What are the Israelis saying?
Well, we've heard a lot from Israeli officials over the weekend as well. And anytime you try to talk about the next day after, or even some New York Times reporting about intelligence failures, they do not want to discuss it right now as they are in the midst of a war. They say what the international community does not recognize, that we are still in the aftermath, which was our 9/11 moment, and we want to make sure that that never happens again. So when you talk to Israelis, they don't really want to go beyond the next 24 hours. They are focused right now at the task at hand, which is very different to John's point. That's not where the international community is. There's already discussion of what comes next. Israel has said they want to make sure that the Gaza Strip is secure. There'll likely be some sort of buffer zone set up. But the U.S. has already come out and said they do not want to see a reoccupation of Israeli forces in Gaza.
It sounds like the Yalta Conference. I can see Roosevelt, Stalin, and Churchill talking about what comes next in the scope of a 6-7 year war. Amory Horton, to that point, the geography speaks. As they move from north to south, in the video we showed earlier, the devastation, 4 or 5 miles from Rafah in the Egyptian gate, if you will, where do all these people go? Is there a path for these people to take?
Well, Al Jazeera is already reporting that a community near that Rafah gate, already 10 civilians have died and hundreds of wounded. This is according to their reporting off of an Israeli airstrike. This is the exact question I asked Admiral Kirby on Friday. Israel had come out and said to all these Palestinian civilians, please flee to the south because we are going to have airstrikes around Gaza City. Now they're going after, please flee to the south because they're going to hit the north. Now you have hundreds of thousands, Palestinians move to the south. And I asked Admiral Kirby, where do they go? And his answers were that they told Israel that they do not support southern operations unless they factored in all the civilians. And then his second point is that they urged yet again to think about how to make sure civilians are safe and pursue operations that account for civilians. But that was his answer. There's no direct geographical place that they are telling Palestinians to go. So it does feel like, and where many progressives in the United States are talking about, is that these individuals, these people are trapped.
Well, and this is the reason why I think it's important to put a little more color around Vice President Kamala Harris's view about, being careful and caution. Secretary of Defense Lloyd Austin coming out and saying the lesson is that you cannot win in urban warfare unless you protect civilians. He went on to say, if you drive them into the arms of the enemy, you replace a tactical victory with a strategic defeat. What is the discussion more broadly then about international pressure on Hamas also to release hostages, to potentially get back to the negotiating table with a better offer, given the fact that there has been increasing pressure on Israel? They've hardened their stance. Where is the tit for tat in terms of pressure?
Well, right now, the Qataris are still at the negotiating table trying to get both these sides together. The United States says that truce ended up failing, or it stopped the tactical pauses they had because of Hamas. And it was due to Hamas not releasing the names of the hostages the evening before. There's still a number of hostages, at least about 8 Americans, the U.S. administration believes, is still with Hamas. And I asked Admiral Kirby about this again, and he said he'd be remiss to say that they knew exactly where they were and exactly their condition. So the situation is incredibly complicated, but there's a ton of international pressure on Israel as well to make sure they could try to get more hostages back, not just from the international community, but also Israelis. The majority of those individuals there are Israelis. When it comes to Hamas, there's international pressure all around, but do they really care about international pressure unless potentially maybe it's coming from Tehran or Lebanese Hezbollah?
Anne-Marie, let's finish with things at home. It is normal to have division in any government on massive issues. In fact, some people would say, I would say, it's healthy. How unhealthy is the division emerging within this administration over this war?
This administration and as well as the Democratic Party. We heard from Pramila Jayapal yesterday on CNN's State of the Union talking about we cannot have hierarchies when it comes to crimes, when it comes to warfare. This could be a problem for the president. I think it's why you see a tougher tone. It started with Secretary of State Antony Blinken's third visit to Tel Aviv. We heard from Lloyd Austin over the weekend, the defense secretary, and the vice president, Kamala Harris. Within the Democratic Party in Congress, there's those that now want to put strings attached to Israeli aid. And then within the administration, you're seeing leaked reports and cables out of the State Department that they do not agree with the administration's full throttle support of Israel, as the civilian toll of Palestinians is now north of 15,000.
AMH, thank you. Anne-Marie, down in Washington, appreciate it. TK, the arguments you're going to see over aid on 2 fronts, Israel 1 and Ukraine 2, they are going to be huge in the new year.
And changed over the weekend. One correction, John. Mike out on Twitter nails this. Thank you, Mike, so much. I mentioned Yemeni drones, and he said, let's be careful here. It's not Yemeni drones, it's Houthi drones. The smaller group. Key distinction there, but it does speak to Americans in harm's way here. We are not removed from this conflict because we're floating out in the Mediterranean and the Red Sea.
It's also just become a massive political division that we've seen. The divisiveness within the Democratic Party is something that's going to be transformative in a pretty massive way.
Happy talk in December about everything going on right now. I think the market just kind of ignoring what's happening in Washington, nothing to talk about. Early next year, big reality check, eh?
Very much so, hitting some deadlines for that budget.
From New York City, this is Bloomberg. Equities on the S&P 500 pulling back by a third of 1%, just a little softer, lighter negative to kick off this trading week following a decent week of gains. 5 weeks of it. On the S&P, we're down a touch. On the Nasdaq, we're down a half of 1%. The Russell, the small caps, up by 0.4. Let's turn to the bond market, offering some support to this equity market run over the last month. Yields are up this morning across the curve, particularly at the front end, up by 6 to 460.21. Last week, down aggressively. Chairman Powell, did he or didn't he try to push back, Lisa, last week? Because if he did, this bond market wasn't listening.
He did without conviction. He tried to basically say a party line that wasn't with any sort of heartfelt meaning that he was going to push back, which the market took as an undying, dovish call for rate cuts starting in March.
So next week, they've got a tool to do something about this, don't they? They've got the summary of economic projections. TK's favourite thing, they have the dot plot. The dot plot for 2024 to signal they're not going to cut anytime soon, except in the dot plot currently, there's rate cuts, isn't there?
There is, but it's later next year, and it's not that many. It's versus the, say, 6 rate cuts that people are talking about now next year, priced in for the Federal Reserve at one point. I mean, it's definitely 100 basis points of rate cuts that we're looking at next year. Do they push back against that? And if they do, does anyone care? I mean, we were saying Powell had a chance to push back. He sort of tried to, and people were like, you just don't buy it.
Not working. FX is harder because you have to make 2 calls. On a 2-year at the front end, you just make 1 policy call on the Federal Reserve. In the FX market, on the euro against the dollar, you've got to make 2 policy calls. And last week, we started to think about the ECB cutting much sooner than the Federal Reserve, Tom. The euro down to 108.68.
George Saravelis of Deutsche Bank was aggressive on that. He said that Lagarde and company will get out front and do what the Bundesbank is worried about, which is say, oops, and cut rates.
He said they should cut next week.
Yeah.
He said they should cut
should.
rates next week. He wants to tell us to tell everyone that that doesn't mean he thinks they will cut rates next week. He thinks they should.
I think we're going to go to the jobs report on Friday, and the answer is, okay, you get a shock down. That really changes the debate. But to the Morgan Stanley Goldman Sachs parity, or rather I should say divide, it's all about the labor economy claims on Thursday.
Yeah.
You know, 222,000. That's
still low.
That's a fully employed number.
A payrolls on Friday as well, looking for unemployment still south of 4%. Thinking our survey right now, median estimate is about 180. That can change going into the number. Let's get you up to speed on the top stories. Under surveillance this morning, Israel expanding its campaign across southern Gaza with another ground offensive expected. The military aiming for Hamas leadership as another truce between the two sides appears out of reach. US forces getting involved over the weekend after reports of attacks on 3 commercial ships travelling in the Red Sea. No casualties were reported, but US military officials say Houthi rebels backed by Iran are to blame. Your next story this morning, Occidental Petroleum in talks to buy driller Crown Rock as consolidation grows in the US oil market. The deal expected to be valued at more than $10 billion, including debt. Crown Rock is one of the largest private oil and gas producers in the Permian Basin. Just last month, of course, Exxon struck a deal, Tom, to buy Pioneer, and Chevron agreed to take over Hess.
Yeah, it's in line. There's no question about that. This is a kid out of Texas Tech, a chemical engineer out of Texas Tech. He worked for Exxon, and then he did just like you see in the movies. He went out on his own and bought up half of West Texas, North Texas. I don't even know where it is on the map. And the answer is it's worth a lot of money.
Apparently.
It's the battle, Bramo, to get scale in the Permian Basin. And the little nugget in our story this morning, and I'm sure some of you have heard this before, but the fact that the Permian yields more oil now annually than Iraq on the OPEC committee cartel is just amazing.
Well, and this actually goes to something that RBC Capital is talking about, and the analysts over there, that we've moved more back into an oil market determined by supply and not demand shocks necessarily. And if it's supply, you take a look at the U.S. and some other non-OPEC members, and they are basically offsetting a lot of the cuts to production that you're seeing from the other OPEC plus members. So when you take a look at that, Two questions. One, antitrust is sort of interesting. And two, how awkward does it make it for U.S. energy officials to go over to COP28 and to talk about reducing fossil fuel emissions and taking the high road on that when the U.S. is accelerating production at a rate that is exactly counter to what we're seeing in the Middle East?
Got the number right in front of me on the Bloomberg. DOETCRUD. Remember that one for Bloomberg users. 13.2 million barrels a day. TK, 13.2 million barrels of oil produced in this country every single day.
Do we have a national energy policy?
They don't speak about it.
They don't.
Not that piece of it anyway.
There isn't a national energy policy, and many would say that's why you're quoting those numbers, is because we didn't have it's a really interesting debate. What else do we have?
This last story, Tom. Swiss drug maker Roche looking to join the rush into weight loss drugs. Roche agreeing to pay $3.1 billion for Carmot Therapeutics, which is developing drugs to compete with Ozempic. Roche among the first companies to test the GLP-1 drug, but had to stop more than a decade ago after patients quit due to nausea.
Yeah.
Saw that last week as well, I think, with Pfizer. The weight loss market is expected to reach $100 billion by the end of the decade. And the year-to-date gains in pharma, basically, you've either got it or you haven't. Novo has it, Eli Lilly has it, and they're up big time, and everyone else, Tom, struggling to catch up.
And the heart of the matter is who's going to pay for it? I mean, I get the whole efficacy of it in the national. John, you've been very good about this, the diabetes and the heart disease and that. But okay, is this a new government program we're going to have to slosh out $8,000 a year, I'm guessing, for a drug?
We spoke with Sam Fazeli last week, and he was basically saying of Bloomberg Intelligence, who's worked with pharmaceutical research for a long time.
Yeah.
First of all, he said a lot of these drugs have been around for a long time, the technology of them, and that they have not found material side effects over the long term with usage, which raises this question, at what point does it become national policy to reduce healthcare costs? Yes, that will mean insurance will pay for it. It'll also mean that healthcare costs will go down in other ways. It's going to get really interesting, which is the reason why everyone is willing to bid up for this.
Yeah, well, there's the drugs, and John, there's also the Bramble method, which is run 15 miles a day. You know,
that's one method.
That's one method.
But this is also, Tom, about addiction, and I think we're only just sort of scraping the surface around the addiction side of all of this. So this use case can go beyond obesity, Tom, perhaps to alcoholism, maybe even gambling addiction as well. The use case for these drugs, I think, is only just starting to be explored, Tom. This can make a big change. What strikes me, though, and we've talked about this before, you have to use it indefinitely. Tom.
Yes.
Indefinitely.
Yeah.
So, of course, cost needs to come down drastically to make that work.
We'll have to see. We'll continue to study this, I should say, and we do this with Dr. Fazeli, who's truly world-class. Thrilled to have Sam Fazeli with us at Bloomberg. Right now, and this is a joy, sitting with us here in New York, Winnie Caesar joins us, Global Head of Strategy at Credit Sites as well. In the heart of your note is what I thought about the most this weekend. And I'm going to go to Lawrence McDonald with a great insight this year. The cash on the sidelines. It's jaw-dropping. When yields come down, do they all exit the money market fund to buy Apple?
I don't think that they all exit the money market fund to buy Apple, but there's an awful lot of yield left in the corporate credit markets, in high yield, even in leveraged loans, maybe in equities that is definitely going to be bought. And you don't need to see all of that money come out of money market funds. I mean, we've had $1 trillion go into retail money market funds this year alone. Right. Just a drop in that bucket is absolutely going to drive spreads tighter.
You are pro in the Bramo world. These are questions Lisa should be asking. I'm going to front run her here right now. Where in the spread market is the thing that identifies a tip point when that money moves?
So one thing that I'm looking for is front-end retail flows. They have been absolutely abysmal in corporate credit this year. Historically, there's a very strong bid for that front end because that's where there's actual yield. But right now, cash is where you get the yield, and you have a very flat yield curve. So why would I go into the front end of corporate credit? But once we start to see those flows start to accelerate, then I think that you have a good forward signal that you're going to have a wholesale bid for kind of duration extension and for spread products.
Have the high yield and investment grade bond markets been insulated by the private credit markets in a sense that the high yield and investment grade are both much better quality and more transparent than the massive world of private credit that has grown up and ballooned and doesn't reset in real time?
It's interesting because you historically don't think of the investors in private credit and these kind of smaller mid-market caps as the same as in the investment grade universe. But you see all this institutional cash going into the world of private credit. And I think that it's interesting that you've seen all of that cash being raised while at the same time you've seen very steady institutional demand for U.S. investment grade with very sticky long end spreads. So that indicates to me that you are actually seeing this kind of tandem bid that's almost a barbell strategy in terms of risk, saying, illiquidity and private credit feels okay for right now if I can add some yield to portfolios, but also I do want that core bid in the long end of the investment grade spread curve.
Let's talk about your year-end spread targets for next year. 350. So I'm just looking at the chart. The Fed starts hiking in spring 2022, and you've got credit spreads going back to spring 2022. Next year. What's behind that? Is that with recession, without recession, with rate cuts, without rate cuts?
So we do expect that there will be rate cuts. We think that the first one will be in March. We expect 4 of them. Now, that effectively is market consensus at this point. But when I was telling clients that in October, people were looking at me like I had multiple heads. So we're sticking with that trade. We're not going to add more rate cuts at this point. And we think that's still kind of this bumpy landing. It's not going to be all Goldilocks. It's not going to be easy. But we do think that there is a path for inflation to continue to come down, for the consumer to soften up a little bit, for the Fed to actually stay in quite restrictive territory with real yields and real policy rates being quite positive, but with credit markets being able to perform quite well in that environment, with the exception of those really lower rated, highly leveraged, triple Cs, leveraged loans. That's where the real pressure and borrowing costs is going to remain.
How unusual is it to see the unemployment rate climb only a little bit? And when would you know that maybe this is not the right call and to back away from it?
It's very unusual, but also the past 3 years have been highly unusual, right? We still have management teams that are very focused on how can we keep labor forces in good shape to meet whatever demand. And also, we can't always just equate recessions or economic slowdowns to the COVID pandemic or the GFC. You can see this kind of more typical slowdown, more normalization in terms of run rate of demand.
So in other words, do you think that the default cycle is going to be pretty small because rates will come down so much that basically the refinancing risk won't be as significant as it is now?
I do think that it's going to be a very manageable default cycle, and the market has become increasingly good at kind of pricing in forward defaults and knowing where to anticipate those things. Now, the big issue is that we have looser covenant structures. We have this new trend of kind of creditor on creditor violence, and so, big erosion of positions that way. And we do still have a lot of cash on the sidelines in terms of private credit. So, if you have these leveraged loan issuers that are a little bit under pressure, that's more cash that's probably going to get kicked in and extend that default cycle a bit further.
Winnie, thank you. Appreciate the clarity on some big issues. Winnie Caesar there of Credit Sites. Constructive, I would say almost on the edge of bullish there, Lisa, on certain parts of credit going into next year, even with this conversation potentially about recession and rate cuts and all of the above.
That's straight up bullish. I think that you can go there. If you're talking about spreads compressing and benchmark rates compressing, that's a pretty significant drop in yields, increase in price at a time when ostensibly we're getting a slowdown in the economy. Again, credit has not sent a different signal than equities. If credit is a leading indicator, it says to equities, let's go.
It's not screaming recession anymore,
No.
is it? No, not at all. If you are just joining us, welcome to the programme. The scores look like this Monday morning. Good morning to you. We are lower on the S&P 500, negative by 1/3%. Yields are a little bit higher by 5 or 6 basis points on a 10-year, 4.2510, and a ton to look forward to this week. In the market, Jobs Friday, Payrolls Friday, just around the corner. The estimate at the moment, 180,000. Tomorrow, stacked lineup, TK, on this programme. Taking a visit to Apollo, catching up with our friends Torsten Slock, Jim Zauter, Mark Rowan, and a whole lot more.
This is incredibly well timed, and I give major credit to you, John, for really providing leadership here and putting this together for us. Jim Zelter with us in London a cup of coffee ago. But it's just an incredibly important time to speak to them, not to defend private markets, but to say forward, how does private markets fit into global Wall Street?
Yeah, and how much they're actually taking over a lot of the functioning of a lot of the bigger banks. Not necessarily with any disagreement from the big banks. The big banks are saying we can't afford to be in those businesses anymore from regulatory perspectives, so we're going to work with you. But at the same time,
I agree
that's
with
where
that.
lending is really operating in big ways.
Michael Spence, the laureate, would say that's what happened. We regulated the big banks out of the risk business because of the screw-ups of 2007, 2008. And with that, somebody else had to pick up the slack. And we call that, it's like KKR last week, that wonderful interview of Shinali's.
The longer-term themes here as well, how retirement investment is going to change in the years to come.
That's where Apollo is, more conservative, more traditional than the fancy back and forth of private equity.
You can afford to be more traditional if you're getting 5%
Is there breakfast?
on
They're serving
benchmark
caviar?
yields. I'm just saying.
Do we get caviar?
I'm told, I've heard a rumor we get breakfast. I don't know about caviar. Caviar at breakfast.
Caviar at breakfast.
It's very tea cake.
There's lox, but not caviar.
The same thing.
A lot of the optimists have been hanging their hat on the strength of the consumer, and the consumer has remained strong. There's obviously appetite to spend. There's appetite to travel. We're seeing the consumers still get out there and spend their money both in stores and online. Right now, I think the market is in this place where we're not sure if we're going to have a cyclical expansion or not. We haven't confirmed in one direction or another, and we're sort of waiting to see.
That was the brilliant Liz Young of SoFi, the head of investment strategy going into the weekend. And the consumer in America has been spending. We saw record Black Friday shopping online, a record Cyber Monday. And 2 Sundays ago, we had the busiest day in US history in American airports. And we have a deal this morning to talk about for US airlines. Alaska Air agreeing to buy rival Hawaiian Holdings for $1.9 billion in cash and debt. The price action, Tom, stacking up as follows, as you might expect. Hawaiian Holdings absolutely surging, flying even, up by 184%. What was wrong with that?
Well, I mean, the drive of an F1 truck through the gap between GM and Ford's estimates. The shares are flying after the airline merger. This is just fantastic. I love it. It's so good.
Thank you. I'm done. TK, pick up.
On this airline transaction, we will look at it right now, understanding Alaska Air is small and Hawaiian Air is even smaller. Looking at United, Delta, and American Airlines is Helene Becker, Senior Research Analyst, TD Cowen. Why did this happen? Is this 2 mini dinosaurs mating? What's the why here versus United, Delta, and American?
Hi, Tom. So I think the why is twofold. First of all, this is a continuation of the consolidation we've seen in the past for the industry, but also during the pandemic, we didn't have the consolidation we probably should have had. We had the government stepping in to save the airline industry, and unfortunately, they couldn't save everybody. So now you're getting that washout. And I think for Alaska and Hawaiian specifically, it really will help them cross the bridge to the other side of the river, so to speak, where they'll be able to survive as a consumer brand.
Away from the financial part, Helene Becker, where is the flight that really is going to add value here? Is it LAX to Hawaii, something John's taken 1 million times? What's the flight where you thought, wow, this is where the synergy can happen?
Yeah, I think it's more Hawaii to the mainland. For people who come, first of all, Hawaii, as you know, is very remote. I think it's one of the most remote places on Earth and one of the hardest to get to. And so for people who live in the islands, they do tend to go either inter-island or to the West Coast. They don't really reach too much into the mainland. And if they want to, it's usually more than a one-stop flight. For Alaska, it gives them the opportunity to be bigger. I think the combined airline will have over 300 aircraft. Revenue will be about $13-14 billion. So it's not like they're close, right? Your comment before about American, Delta, United, those are $50 billion revenue companies. These are small. And they serve a purpose. People fly them, right? They fly 80-85% load factors. They both deliver a great product. You're not really changing a whole lot, unlike with JetBlue and Spirit, where you're changing more. Not to say that merger shouldn't occur, but we're looking at airlines, to your point before. Hawaiian's up, 180% pre-market. And that's primarily because under $5, the market's telling you these companies can't survive. And we have a lot of airlines in that under $5 trading range right now. And so we're seeing that consolidation that should have probably already occurred.
TK Direct, Newark, Hawaii, United.
No way. You can fly direct from Newark to Honolulu?
Amazing, isn't it? You can fly direct from Newark on United. There you go.
I did not know that.
Yes, you did.
I did.
Give me a break. Let's get into it, Helene. Not that. The important stuff. JetBlue and Spirit held up. The alliance between JetBlue and American Airlines crushed. What will they allow? What won't they allow? We can see this morning that Alaska are making a very clear statement that they don't think this is anti-competitive. They're complementary businesses. The overlap is only 12 routes, 3% of their total seats. Can you frame for us what is allowed and what isn't?
Yeah, I think this Justice Department doesn't like anything big. And it's not like these guys are going to be big. JetBlue and Spirit isn't big, right? They go to be the 5th largest. JetBlue Spirit goes to be the 5th largest. Alaska Hawaiian is going to be right in there, 5, 6, something like that. It's not like we're going to take over the 4th largest spot. JetBlue and Spirit are 9% on a combined basis. This is even smaller. So I suspect that if they look at this on a I don't know the right word, on a just the way they should, on a not with a jaded eye, where they're just looking at it, does this deal make sense? They should come away with, yes, this transaction does make sense.
Well, Helene, just to put a bow on that, if they approve this transaction, do they have to approve Spirit and JetBlue?
Well, Spirit JetBlue should have, is where it belongs, right? They're in court. Closing arguments start tomorrow. Should take to the end of the week, I would think, if even that long, and then the judge renders his decision. So, the one-word answer, Lisa, is yes, they should just move on and go fight other battles.
How much is this going to be some sort of consolidation of aircraft, consolidation of workers, consolidation of operations, and how much is it going to be just the actual geography of these places? People go to Hawaii in the wintertime and people go to Alaska in the summertime, and they can offset each other.
Right, exactly. So two things there to think about. They're both kind of bucket list trips, right? From the mainland, especially the East Coast, it's 15 hours nonstop on the United flight out of Newark. Hawaiian flies out of JFK. They used to fly out of Boston. That flight, I think, came back post-pandemic. So they do fly here on a nonstop basis, but those are 15-hour flights. So those are bucket list trips if you're coming from the East Coast. In terms of operations, they said last night that they're going to operate the two separately, one operating certificate, but two separate brands, sort of the way hotel chains do it, right? You have 14 or 15 brands under one major holding company. Same thing here. They're going to just operate Hawaiian separately and Alaska separately because both companies really do have great brands and they're well loved by the people who fly them a lot.
Elaine, just to wrap things up, to get your top pick, the airlines have bounced recently, but are still some 27% from the altitude we hit back in the summer. Do you like that, Bram?
That was good.
For you.
That was
Thanks.
really good. I liked
was proud
it.
of that.
It was good.
Elaine, what is your top pick at the moment? We had the busiest day on record for US airports only a couple of Sundays ago, and these stocks over the last few months, yes, more recently have rallied, but it's been difficult since the July peak.
Yeah, people have been worried about a consumer recession, et cetera. So our best idea for 2023 was United, and our best idea for 2024 is Delta.
Why the change, Elaine?
So the change primarily came for two reasons. One, United's been our best idea for the past 2 years, and it's mostly worked. But they're embarking on a $60 billion 10-year CapEx program, and we don't think Delta's is going to be quite as aggressive. We think Delta's will be smaller than that. At some point, they'll have to replace the 717s. They'll probably do that with A220s, but it's a much smaller CapEx program. Delta has a similar footprint to United. They're just a little bit bigger domestically than United. United's 50-50 domestic international, while Delta's more like 60-40. So we just pivoted a little bit to Delta. The balance sheet, the order book, those are a couple of the reasons why.
Appreciate the update, Elaine. Elaine Becker of TD Cowen. Best idea for next year, Delta Airlines. We've got a pretty even split around the table. No bias here on Bloomberg Surveillance. TK United, Bramo Delta. I'm sitting here for American. Bramo,
pretty good, yeah.
Delta analyst.
Yeah.
Top pick for next year.
Well, I think there are a couple things. First, they did back off on some of the point changes to get into the lounge.
They're listening.
Delta One is, nice, but I also think they're American Express. Combination. And they're basically, how much are they becoming a financial company versus actually?
I mean, Lisa, when John goes to Hawaii, he's staying at the Moana. It's where President Obama
is he going to sing
as well. But John's large.
It's a lofty place.
He's at the Moana, and he's right by the beach there.
Actually, I was in Lanai and saw Netanyahu.
Yeah. How about that landing into Lanai?
Yeah,
how about that?
That's rough. That's rough. Let me tell you.
Rough. I mean, you're looking at when folks on a cliff here.
When it starts doing that as it's coming in, and all you see is this red cliff.
Welcome to Hawaii.
It was romantic and beautiful.
Until it wasn't.
Scenic until it really wasn't.
It really wasn't.
And haven't been back. Don't think I'm going back.
Oh, there's an endorsement. It'll be
it's a beautiful island.
You and me at the
beautiful
Moana.
Island. Let me be very clear. Beautiful island. Let's just say,
not so much.
No. Small planes, me, no.
Brutal. Worst ever.
Worst ever. Not for me. From New York City this morning, good morning. Stocks are lower by a third of 1%.
I think certainly we're at the end of the tightening cycle.
The economy is going to stall later next year. The impact of policy tightening is clearly coming through.
The market's gotten into its head that no hikes equals cuts. And I don't think that's quite right.
2024 is really a recalibration of monetary policy.
The only thing we're really certain about is that the market is facing uncertainty.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. A Monday to carry on from last week. Market's a little shakier, but John, wow. After a Friday that just shocked into the end, the 10-year real yield under 2%, we have to recalibrate into the jobs report.
41 basis point move at the front end of the curve, 2-year yield lower, and we've said it repeatedly through this morning. If you think Chairman Powell was pushing back, he got steamrolled by this bond market on Friday. TK, this market believes this Fed can cut for all the right reasons. Disinflation without a recession. That's the good stuff. Will the labour market hold up? Look to Friday. Based on these estimates, it will. 3.9% unemployment, 180,000 on payrolls growth. And Tom, that looks pretty good, doesn't it?
And pushing against this is GDP. I mean, there's a lot of fancy work, OECD, IMF, global slowdown, and all that. And to me, the zeitgeist this weekend was, well, maybe with the consumer the way they are, we're not going to see, recession, maybe. Tony Dwyer looking for that. But just maybe not the gloom slowdown that gets you to the bear market call.
Alarian warned about this going into the weekend. He said, extrapolating out the euphoria, the understandable euphoria of the last month or so, Tom,
I think you meant the tots.
Maybe that's a mistake.
Yeah.
You did something over the weekend that I quite liked. I think we should do this. The Economist of the Year. We should have the equity strategist of the year.
I do that. I think people care.
Let's do the Economist of the Year right now.
Because there's a lot, but the Economist of the Year is the guy that delivered optimism and a belief in the American experiment out of this terrible pandemic. A guy named Neil Dutta at Renaissance Macro wrote a brilliant essay for Business Insider with nuances carrying forward his optimism.
I pulled out a quote from that, TK. Lisa, what do you make of this? If 2023 was about the hard work of stabilising the economy, Neil Dutta of Renaissance Macro says, then 2024 is about enjoying the fruits of that labour.
This is something that is a tension point for me, because if you enjoy the fruits of that, that means disinflation, a return to maybe 2%. How? And this, to me, I think is the biggest question. How is that, given some of the increasing optimism around the numbers that we've gotten and the fact that people are still spending money? Is that disinflation? Does it really warrant 5 rate cuts that are currently priced into the U.S. market next year?
I read Mike Wilson's note carefully, as a leader of the bear market, cautious, one of the guys out there saying, forget about the bull market. But the answer is there a bear market call right now? I really couldn't find it, except for one guy over at J.P. Morgan I don't think he's in the new building they're building.
4,200 with a downside bias over at J.P. Morgan, the investment bank. That's the call.
There's different parts of J.P. Morgan we should
This is the investment bank. This is the research team led by Marko Klanovic and Dubravko as well. Look, the call stacks up. Whether you disagree with the number, the logic kind of makes sense. And Lisa and I were talking about this on Friday.
Sure.
What is the bet in the market right now?
Sabbatical.
J.P. Morgan is essentially saying the bet in the market right now is a near perfect soft landing.
Right.
And ultimately, Lisa, they're pushing back against what's priced because they don't think it's going to be that great.
Well, and Dan Morris kind of alluded to this, that it was sort of heads you in, tails you, I lose, or something like that for equities. When it comes to, I totally messed that up, but this idea that, when it comes to the payrolls report, if you get an upside surprise, it's going to be bad for equities. And if you get a downside surprise, that's going to be bad for equities, because essentially they're pricing in a Goldilocks that only a number that comes exactly in line with expectations can confirm.
We backed up on the 10-year inflation-adjusted yield. Never did I think, John, we get so abruptly under 2%, 1.9x%. We backed up to 2.04%. I guess waiting to see if we get more dovishness out there.
Huge turnaround for bonds. So let's go through it together. The 2-year at the moment, 461. It's up 7 basis points today. But think about how much lower it is compared to October. Mid-October, 526 on a 2-year, pushing those levels. On a 10-year, back in October, through 5%, back down to 426, even with a 6 basis point move this morning. So that's a turnaround for fixed income. Elsewhere in equities, we're negative 1/3% on the S&P 500. And what do you do with the euro? TK, the euro 108.67, slightly negative. Forget the Fed call. You've got to pair it with an ECB call. Call of the morning. George Saravelos,
no question
Deutsche
about
Bank.
it. Yep.
He said, based on the data right now, they should be cutting next week at the ECB. Doesn't think they will. He thinks they should. Call of last week, Jeff Yu, BNY Mellon. He thinks, Tom, we go back to parity on the euro next year.
I just think these are some of the dynamics, and I do agree with you. You've got to parse together the major banks, even Bank of Japan in that soap opera.
Bank of Canada.
As well. Right now, on the what do you doing is Dana Dioria, co-CIO group president of InvestNet. It's one thing to talk economics, finance, investment. It's another to say, okay, this is what you should do. Dana, I've got to go to your wonderful paragraph on the Magnificent Seven. You've got some enthusiasm, but you brilliantly show that they're 28% of market cap, and yet they only deliver 17% of earnings. Why do we own them up to our eyeballs?
Well, that is the nature of growth, right? The multiples are certainly higher. And let's face it, in the last several years, they have proven to be truly defensive as a play, as well as, the bull run coming from them. So it's really hard to argue yourself out of the Magnificent Seven at this point, and all sorts of problems in terms of active managers. We have, hundreds of active managers on our platform, and, even to the extent that now when trying to diverge from the index, you have problems because Magnificent Seven is so big in there. So certainly my remarks are not to say that you're going to divest the Magnificent Seven. That has not gotten anyone anywhere. But I would say focusing even more on them is not the place to be.
Okay, Dan, I'm going to rip up the script here. This is too important. Are you tilting then in helping people with a balanced portfolio, active or passive investment?
Well, we are very much believers, and we actually have a lot of research on active and passive investing that, that both need to be in the portfolio. I know that's not as fun of an answer, but the bottom line is that passive investing has gotten to be so low cost that the average investor is very hard for an active manager to outperform passive on a regular basis and beat their fees as well. That being said, we know that there are certain style factors that work. There are certain strategies that work. And, if you're sticking only with passive and you're in an advisory relationship, you want to outperform the fees that are attached. You want to outperform tax. So we think both need to be in the portfolio. Certain asset classes might be better for active, particularly quant active, than others.
Right now, I'm looking at a bond market that really has a mystery baked into it, which is, can the Fed really cut rates by more than 4 times next year, which is basically what the market is baking in? Do you lean against some of what some people are calling the euphoria of a soft landing, the Goldilocks forever that we heard from Max Kettner?
I do, but it's getting so hard to be there, right? Because you've been sitting there all year. The market just keeps telling you you're wrong. I genuinely believe that it happens with a lag. And, you talk about that on, a broadcast like this, and the expectation is that you're talking about something that's happening any moment, right? But the fact of the matter is we had massive increase in interest rates that just haven't totally hit the economy yet. We have indications from, proxies for short rates that it's actually tighter than the Fed funds rate would suggest. So I do think that, the market has a decent chance of slowing down next year. Does it mean it's a massive crash? No, not necessarily. But, I don't, advocate kind of chasing after stocks and not being balanced in the way that you go to the market, which is what we kind of see, right, on our platform. Again, when you look at what are the big winners of the year, it's S&P 500 ETFs, it's QQQ, it's where folks are just trying to make sure that they don't lose out. But balance in that way that you're engaging with the market, I think is appropriate. And I do think that we're going to see some impact. I also think inflation may not be defeated, right? Inflation tends to come in waves. So everyone's talking about disinflation. Hey, that'd be great, but I don't think we're able to make that call yet.
Danny, do you think we might be confusing a conversation on the economic cycle with one on the profit cycle? I think RB advisors have been great on this. We're having a discussion about an economic recession that might be in our future, when arguably we've had the profits recession already. Danny, do you think we have?
That's a very good point. I mean, look, most of this year that has been the case, right? And then, there's questions around productivity and does AI step in and make it possible for companies to keep doing very well next year, right? We seem to have in this last earnings season turned the curve on that. And so, next year, presumably we're out of it and we do well. But of course, again, when you think about credit tightening the way it is and continuing to tighten, and the bifurcation now you're seeing, which is interesting too, with, for example, large cap and small cap growth, right? It's not just about where interest rates are, it's about what firms can self-fund, have enough cash to handle their operations and don't need to go out to credit markets, don't need to be turning over debt in a situation where debt is going to be much more expensive. So I think all those things come to bear. I think there's an argument to be made that we have had the earnings recession, but that doesn't mean that there's not more for corporate teams to contend with next year. Again, for example, if you need to go to credit markets to fund your operations.
True. Dana, thank you. Dana Dioria there of Investnet on this market, Tom. The difference between a conversation about an economic recession that might be in our future and perhaps a profits recession that may well be in our past.
What's great about that is it's about what do you do? And she alluded to the fact so many people have missed this market. We're all talking about the great November and things are great into December and it's double digit, and even SPX up double digit. And yet when I talk to people, they're not feeling the good feeling.
Well, it's where are they, right? I mean, the profit recession where? The profit recession in tech, yeah, that's over. The profits recession in other sectors that have been beaten up, like, for example, banks, maybe to some degree, although I don't know that we ever had a profit recession there. But in small caps, you continue to see a lot of pain there, right? So there's sort of this question of where does the recession hit? If it hits small caps, you can still see pain. But the headline figure on the S&P and the NASDAQ can still go up quite significantly.
The massive extremes. I believe I did this. NASDAQ 100. The top 7 stocks are like 38 or 41% of the index. I mean, it's absurd.
This market's upside down sometimes. You see the banks last week. Banks on the S&P, Bramo, up 4% last week off the back of a 40 basis point plus move at the front end of the yield curve. We came into this year and our understanding of the bond market and relationship between bonds and bank stocks.
Yields up good.
Yields up good, yields down bad.
That worked out.
This year, yields up bad, yields down good.
I can't really explain it right now. People point to the yield curve that maybe it was less inverted. People point to the fact that higher yields are good, but at what pace? Higher yields at too quick rates are difficult for banks that are holding on to pretty big portfolios of treasuries.
We'll have this discussion a little bit later. If you're just joining us, here are the scores on the S&P 500, negative 0.3%. Yields higher, Tom, by 6 basis points, 425.68.
On Friday, 4-something p.m., the Wall Street Journal featured the Bloomberg Total Return Index is a good measurement of bonds price up, yield down. I went to the Bloomberg Total Return Index, John, this morning, and I looked at how far do we need to go up to get back to the good times. And the drawdown in price, we need to go up 14%, which I'm going to put at, say, 2, almost 3 years of coupon to get back. There's a lot of total return we need to do to get back to the good feeling we had in bonds after those losses.
We had a lot last month, let's put it that way. But yeah, I'm with
nice
you.
jump, but there's a long way to go.
Work to do. We'll have that conversation in the next hour on Bloomberg TV, on The Open, Sonal Desai of Franklin Templeton, Greg Peters of PGIM, and on the equity market, the year ahead in 2024, Barry Bannister of Stifel. I imagine Sonal might have some pushback for the move we saw in the bond market, Elisa, last week.
I suspect so. I think a lot of people are starting to think about it. I mean, you can hear that from Max Kettner. he kind of doesn't believe it. Nobody really believes it, but when do you actually push back against it? Do you kind of ride it for a bit longer? I mean, that's sort of the discussion people are having.
The title of Max's note is still Goldilocks forever. Question mark. I mean, I get it's a question mark in it, but he's still pushing Goldilocks.
That's my point.
And all
it's
that
sort of what's going to make it stop.
Yeah, I'm with you.
I mean, do you feel Goldilocks?
Do I feel it?
Yeah.
Do we ever feel it?
Expectations with the mergers of some airlines.
Oh, right. That was good.
That was terrible.
Nice pun, Bramo.
Oh, thanks.
From New York, this is Bloomberg.
Tuesday, a special episode of Bloomberg Surveillance live from Apollo's headquarters. Join Tom, John, and Lisa for exclusive interviews with top leaders in finance, including Apollo's Mark Rowan and Jim Zelter, about the state of private markets, recession risk in the new year, and deal-making amid high interest rates. It's all happening December 5th, starting at 6 a.m. Eastern on Bloomberg. Context changes everything.
It's very important because the reality is that we've had the hottest year on record. We're aiming for another hot year. Clearly, this has to change, and you can't make climate and fight the climate issue without money coming to work on it. So it's one of the most important things. When I traveled around the world, I picked up the impression that dealing with poverty cannot be by itself. You have to deal with climate, pandemics, fragility. These are all intertwined crises. That's why we changed our mission to include livable planet in addition to eradicating poverty.
Ajay Banga, the newly minted president of the World Bank, in good conversation with Bloomberg in Dubai. It is a gathering of the elite as they discuss climate change, which is, of course, front and center. Tom Keene and Lisa Abramowicz with you. John Ferro in preparation for a magnificent 9 o'clock hour. Lisa, your thoughts on COP, whatever it is, as we go to COP 28, 29, 30, and on an annual basis?
Well, there is both a bit of fatalism, right? We heard about people basically saying it seems almost inevitable that we're going to breach that 2 degrees increase that people said was the point of no return. But there was a greater commitment from the OPEC plus nations to possibly cut some of their emissions. And then there was also this question around new energies like carbon capture. I'm actually very curious in what can really get involved there, but clearly that can't offset just reducing emissions. Some of the nuances that are out there, some of the sub-themes, but the overwhelming theme is the United States, China, and use of coal. David Turk joins us now with Secretary Granholm. He is U.S. Deputy Energy Secretary. David, thank you so much for joining us, and you do so with your service to the nation of 6, 7, and 8 jobs in climate. The immovable fact is we're trying to do something about coal. My latest reading is China's really not doing something about coal. What is the department's timeline in America to diminish coal usage?
Well, first of all, Tom and Lisa, thanks for the time, and really appreciate you being with you today. So we've got to look across the board. It's not just coal, it's natural gas, it's oil. We've got to look at all the sources of emissions, and we've got to have a plan to build all the new clean energy. And this is what we've got in the U.S. We've got historic levels of funding through the pieces of legislation, the bipartisan infrastructure legislation, the Inflation Reduction Act. We're building out our clean energy future like never before in our country. It's quite staggering what we're doing.
I go with that, and of course in the FT this morning, a huge difference between a complete climate commitment in Europe to the fractured battle you fight every day in the United States. But to look at coal is one example, particularly with the Chinese just ignoring the debate on coal from everything I read. What is the administration's path to shut down or diminish coal usage across America?
So we've seen dramatic declines in coal in our country, and that's projected to continue going forward. It's because we have cheaper, better alternatives, solar and wind. The solar penetration we've got in our country, the wind, other clean energy technologies, they're just simply cheaper and better, and so the market is reacting to those incentives.
David, I'm looking right now at WTI crude traded on the NYMEX at $73.46. Is this a good time to start refilling the Strategic Petroleum Reserve?
So we have been, and we're going to be opportunistic, and we're going to take every advantage when the price is at the right level to make a good deal for taxpayers. We're going to refill. So we are refilling as much as we can. We've been doing that for the last several months, and at this price level, we'll keep doing it.
And it's been about a 3 million barrel a month purchase that the Energy Department has been making. Do you plan to accelerate that, though, as prices do continue to fall?
So that is the physical limit of how much we can buy back. We've got some lifetime extensions in some of our caverns. We actually have 4 separate facilities, 4 separate sites for our Strategic Petroleum Reserve. So we will be doing at least 3 million barrels. And we hope we can bring more capacity online at these price levels to buy as much as we can to refill, to make sure we've got that available when we need it in the future. So we'll buy as much back as we possibly can, but there are some physical constraints given the way the caverns are set up.
We've been talking a lot about some of the consolidation in the shale patch with a number of companies coming to the fore, the latest coming this morning. Is this a good thing from the Energy Department standpoint or a bad thing?
So as you know, a lot of decisions that are made in the energy sector, certainly in our country, are private sector decisions along those lines, and we're certainly seeing that happen as well. I think one good thing we've certainly seen is a focus from a lot of companies, including here at the climate conference, on reducing methane emissions. This is something we've been after for quite some time. Our EPA colleagues recently announced some big news here in terms of the new regulatory structure to really do what's the biggest no-brainer, I think, in the history of no-brainers on climate, is reduce methane emissions in the oil and gas sector. So we're really stepping up on that, and we're seeing some companies step up on that beyond what they're required to do in the U.S.
I'll take your point on it. There's some real traction on that. You know, I want to go back here. You were an advisor fresh out of Virginia to Senators Biden, Senator Conrad. You've had 18 jobs in energy. You've arguably, David Turka, Republicans and Democrats have more experience than anybody breathing today. How did we get to being an OPEC-sized oil nation? All of a sudden, we're like as big as a rock, or, I'll let you decide what it is. How did we get to this hydrocarbon success that America is today?
Well, first of all, Tom, thanks for the compliment. I'll make sure my mom sees this and hears such a nice compliment. I think the short answer is we are a private sector market, and unless you have federal laws, federal restrictions, the private sector will do what the private sector will do, and they found a lot of profit and a lot of opportunity, including and especially in shale in our country.
What do you say to the critics of the Biden administration that it is not private sector centric?
So look at the numbers, look at where the production levels are at. We also need to, of course, focus on the emissions coming from all of that oil and gas, not only that produced in the U.S., but around the world. And one disappointment I have to say here at the climate conference is, while we've made some progress on methane emissions, that's a big deal, I don't think there's as much focus as there needs to be on oil and gas Scope 3 emissions. That is those emissions produced when that oil, that gasoline, goes into the atmosphere. Scope 3 emissions are actually 10 times the amount of Scope 1 and Scope 2 for many oil and gas companies. So we need a lot more focus on Scope 3 emissions. We need a real credible plan for dealing with those emissions.
David, does it make it kind of awkward for the U.S. to have a leadership position in reducing emissions at COP28, given the fact that U.S. production has increased to a record pace, even as it's cut in places like Saudi Arabia and Qatar?
So I feel incredibly proud to be part of this historic Biden administration when it comes to climate change. In fact, we're actually seeing our emissions decrease in the U.S. 3% in 2023, despite GDP growth healthier than just about every other country in the world. And what you've seen is, with the historic pieces of legislation, all we're doing in this administration, we're expected already, just in these few short years of policy, to actually double our emission reductions by 2030, 40% plus reductions just from the actions from this administration. That's an impressive record, and we need to do more. All countries around the world need to do more, given the climate challenges that we face and we're already seeing in our world today.
David Turk, thank you so much. He's a Deputy U.S. Energy Secretary, of course, from Dubai this morning. I can't say enough, Lisa, Democrats and Republicans, how these are the people that drive the conversation. They may disagree collegially around the table, but you have guys coming out of these academic schools, they've got 6, 7, 8, 9, 10 jobs along, the theme.
And the concept of reducing emissions and the complications along the way really underscores
the political debate, yeah.
Some of the conversations had over in Dubai.
There's a conversation about a jobs report. We're going to dive into that here. First, real look at it. I think that's cool. Who would that be with? It has to be with Michael McKee. Futures negative 16, the VIX 13.27. Stay with us. Bloomberg Surveillance. Bloomberg Surveillance, good morning. John Ferro on assignment, waiting for the 9 o'clock hour. Lisa Abramowicz and Tom Keene. We need to do a market check real quick here, and I got one oddity I really want to emphasize here. The VIX 13.28, SPX negative 16, down negative 89. NASDAQ in 0.5%, down 0.5%. I should say yields are higher off of the Friday festivities. Maybe that's a reversal, some trend there into the opening, to say the least. Lisa, Euro Swissy, and this is again like the 10-year real yield in the United States, showing strong Swiss franc off of what we saw Friday. And, I just get back to the idea of some real movements Friday that changed the landscape.
Well, and George Saravellos and Jeff Yu over at BNY Mellon both think that the ECB is going to cut rates before the Federal Reserve. You have to wonder if the Swiss National Bank is looking at this and saying, come on, really? Because the strong currency has been a problem for a bit. So this has been sort of a tension point, and keep watching this space.
These are the little global tension points that are out there, including Saravellos talking about the ECB. They should act sooner rather than later. Again, futures negative 17. What do you have?
Well, it's an incredible week. And I think about the drumbeat to Friday, kicking off with factory orders and durable goods today at 10 a.m. Tomorrow, JOLTS data, followed by ADP, which no one cares about until they do. Bank CEOs are going to testify before Senate on Wednesday. I hope they ask them about what they're seeing going forward in terms of consumer spending. Thursday, weekly jobless claims, and all of that is kind of the drumbeat. The U.S. jobs report on Friday, which a lot of people say could really make it or break it depending on the number, and then it'll come out bang on exactly the target, and people will move on to saying it's just all about the Fed meeting and how Jay Powell is going to message that.
We're going to get to Constance Hunter here, but first, Michael McKee joins us to get us started on a clearly eventful week. Is the JOLTS survey going to jolt us tomorrow? You once lectured me, tore me to shreds, Lisa. McKee, I was in the McKee timeout chair. Tom, JOLTS matters. Why does JOLTS matter?
Well,
tomorrow?
It's starting to matter a little bit less, unless it goes up significantly for some reason. But right now, we're expecting the number of job openings to have fallen a little bit, according to the consensus, by about 253,000, which would be, reasonably good news for the Fed. But as Lisa said, it's a week of a lot of numbers that will lead Wall Street to sort of give us the statistical version of angels dancing on the head of a pin. Because every little number is going to give somebody some reason to think that things are going one way or another. The interesting thing is it's been a week now since Chris Waller came out and said that the U.S. economy is starting to give. And that sort of let the floodgates open in the bond market. Yeah. But when you look at the numbers that we're going to get this week, we're expecting a better ISM services number, higher ADP numbers, higher jobs numbers. Now, there are caveats to all of those, but it's not like the economy is falling off a cliff.
So let's look at Governor Waller, whose acclaim is research head at the research institution, the Federal Reserve Bank of St. Louis. There's a multi-decade heritage there. And then let's look at Claudia Samm's essay this week and on the veracity of the data that you live and breathe. Is Professor Samm, is Dr. Samm recession queen? Is she onto something here that we can't trust the data this week because it's not countable?
I don't think we can't trust the data. There are a lot of reasons that the data may not be quite as reliable as they were, basically having to do with response rates and the way the economy has changed in terms of technology. But the data are going to be what the Fed uses. So you can use the data. You could say the data may be wrong, but then they're wrong for the Fed decision making too. And unless you have the right answer, this kind of goes back to the old Jack Welch thing of we've seen the BLS manipulate the numbers and didn't make any difference, and he didn't turn out to be right.
I want to go back to where we started, which is that Jay Powell tried to send one message and the market heard something else. I do think that there has been a notable shift in terms of Fed officials not pushing back against the market sentiment. And that's what Ian Lingen and Benjamin Jeffrey from BMO Capital Markets said when they wrote Powell was more balanced than hawkish, which, given the current backdrop, might as well have been dovish. I mean, is that essentially where we are with the Federal Reserve that doesn't care if the market rallies because they do see so much weakness in the pipeline?
I don't know if it's because they see so much weakness. They do see the economy slowing down, and they do know that we have an issue coming up with real rates. We'll see what happens. I mean, you look this morning, and you can see that financial conditions have tightened a little bit after last week. So we'll see that go up and down. But the biggest thing going forward is going to be, I think, the Fed meeting. Jay Powell's always important, but we're going to get the new projections. And remember, in September, they said they were going to cut rates in 2024. So the idea that the market is pricing in rate cuts is not wrong. It's just a question of timing and, of course, magnitude, and that'll depend on the data.
Michael McKee, thank you so much. Greatly appreciated. A busy, busy week for Mr. McKee. Joining us now with macro policy perspectives is Constance Hunter. She's senior advisor with terrific decades perspective here on your central bank. Constance, to the question I was alluding to with McKee, the basic idea is, do we trust the data? We're out of a pandemic. Maybe we're beyond a pandemic. Does all this data have an asterisk next to it, or do you actually believe it's countable and legitimate?
So, I mean, Claudia Sam brings up a good point, and it's something that is talked about a great deal at the statistical agencies. In fact, I'm on the Federal Statistics Economic Advisory Committee. That's a mouthful, FESAC. And we have a meeting this Friday, and one of the agenda items is this exact subject of how is the response rate compared to pre-pandemic, and what needs to be done to A, get it up, and B, use other data sources, triangulate data, have the statistical agencies evolve, but still have the robustness in the data of the random sampling. And that's where the rubber meets the road, is making sure that you're getting an appropriate sample.
And Constance, to your work at NYU and Columbia years ago, the world's changed. We have cell phones. Many people don't have home phones. When we do these statistics, are we counting America, or are we missing parts of America that make us look at the statistics and say they're suspect?
Well, the question really is, are we counting enough that we can then use statistical methods to make assumptions about the economy and the population overall with the proper distributions? And some of what we're talking about here is the response rates of companies sending in survey data to the Fed or to the statistical agencies, rather, some of which is the Fed. And of course, we had a great deal of labor market churn during the pandemic. We had a lot of people moving jobs. So the stability of the actual individuals at companies turning in these surveys has seen a lot of tumult. And that has caused some of this reduction in response rate. So addressing it from all angles is really important. And I would say at MPP, what we do is we have an exercise where we scrub the earnings data. And we look at various things like hiring intentions, firing intentions. We're triangulating all the time to see if we can corroborate the official data. And in a sense, that is what the Fed is doing as well.
How much do you see a real dissonance between big companies that are winner takes all and smaller companies that are really struggling much more directly in line with some of the anecdotes that we keep hearing about?
Yeah, I mean, that's where you see the liquidity conditions really take a bite, of course, is smaller companies with different access to credit, and perhaps that weren't able to go to the capital markets when rates were very low and see a bigger maturity wall coming, or just need access to credit for operations. And this is where the financial conditions really take a bite, is these smaller companies. And so when thinking about the economy overall and thinking about hiring plans, right, it is the smaller companies that are that are feeling a greater pinch and looking more to either slow hiring plans or consider layoffs.
Spotify isn't a tremendously small company. It's a mid-size or larger company. It is a tech company as well. They said that they're cutting 17% of its staff earlier this morning and said economic growth has slowed dramatically and capital has become more expensive. Spotify is not an exception to these realities. You can make an argument that they're also making excuses for other issues that are much more specific to the business, but do you expect this to be the beginning of a whole host of comments like this based on the commentary that you're hearing as you scrub those earnings?
So we aren't seeing a big jump in firms saying that they're planning to lay off workers. We're at about 5.4% on that, and that's relatively low. But when you look at a company like Spotify, you have to think about how these companies reacted during the pandemic. A lot of them overhired and really staffed up during the pandemic, and now they're sort of right-sizing their businesses for a more trend-level growth as opposed to the blockbuster growth we saw during the aftermath of the pandemic.
So do you buy into this idea that we could see a job-full recession or a job-full landing that leaves us with basically an unemployment rate that doesn't rise that much more, but ongoing disinflation that brings us back down to the Fed's target?
That is, Lisa, precisely our base case, right? We're looking at 4.1% unemployment by the end of next year, but inflation very much in line with the 2% target across all of the measures, both CPI, PCE, and core PCE.
Constance, how ex post is the Fed right now? I'm big on data dependency and all the other fancy languages, but post-pandemic, in their mere mortals, to me, they're as ex post, after the fact, wait, than they've ever been.
So, look, they're fighting a really important perception battle, right? And it's kind of fallen out of the conversation last week, but coming into Thanksgiving, there was a strong conversation about, oh my gosh, look at these prices, look at where they are relative to the beginning of the pandemic, look at the annualized rate relative to the beginning of the pandemic versus, yes, the month over month is coming down. So Wall Street economists, we're looking at the month over month rate and we're easily translating in our head, oh, that equates to a 2.2% annualized rate. We're on a good path. If you're a person living out in, not only are you subject to money illusion, where you have a somewhat irrational response to price changes relative to your income, you also anchor to certain things that have gone up in price, and you don't anchor in a smooth way. And so they have a perception issue with Main Street versus Wall Street, and making sure that inflation expectations are anchored. That's an important part of their calculus right now.
Constance, thank you so much. Constance Hunter, a macro policy perspectives there on the Fed Chat Forward. And what I learned there from McKee and Hunter, at least it's just simple as this. Boy, are we going to have a different view Friday in the vicinity of 8:32 a.m. There's a lot of data coming out.
And it's going to be interesting to see how much we can extrapolate out. This idea of a job-full recession, right? This idea or of a job-full downturn, this idea that you're not going to get layoffs because people are still hoarding labor, is a real question mark at a time where you also have a lot of industries in flux. It's a big question to me. That's what I'm most curious about. Do you see maybe a decline in hiring, but not an increase in unemployment filings? Could that be kind of what people are looking toward?
There's a lot of dynamics there. And what's interesting to me is the regional dynamics, and you see it in rent and housing and the rest, where the West is really pretty soft as well. Futures deteriorate. It wasn't Constant Hunter's fault. We went from negative 15 down to negative 22. That's half of 1% down.
Yeah, and coming up, we're going to be just parsing out how much we can carry over from November into December. It feels to me like people want to push back against some of the move that we saw last week, particularly in the longer-term yield space, given the fact that they don't really buy that the Fed's going to cut so aggressively next year and that inflation may remain somewhat elevated, but they don't really have the conviction to do so. It's kind of my feeling right now in the market.
Well, it's going to be interesting to see. And, you know, I think there's a lot of Fed gazing and all that, but to me, it's about the data dependency that we've talked about. And I look at the data dependency as when does the job market crack? And to Neil Dutta's wonderful essay in Business Insider, clearly the optimist of the year, the one who nailed this more than anybody in the trenches. How lonely was he is the labor market just flat out hasn't cracked. There's no other way to describe it.
And we're talking about that even though Spotify said that it was cutting 17% of its staff, right? In another time and place, people would have said,
Well, sum it up. They've cut 25% with the three. They're on their third tranche of rationalizing.
I mean, honestly, some people would say this is the beginning of something broader, especially because they cast it as a larger economic story in their release explaining this. Is it that? Is it just simply they overhired? Is it the whole tech overstaffed story that we saw back in the day?
Just possibly, maybe I was wrong that the great zombie roll-up wasn't last year as I thought it would be, but maybe it's this year.
Are you saying someone's going to take out Spotify?
No, look at Alaska and Hawaii and Hawaiian Airlines. I mean, there are two airlines that basically can't survive unless they mate. I thought Helene Becker was very good.
What did you say? Mini dinosaurs?
Mini dinosaurs. Is that what they are? I don't know. We'll listen to the pros on this. Stay with us, Bloomberg Surveillance.
For the next year, yes, we expect rate cuts. Yes, we expect the data to slow. We expect a recession by the second quarter of next year. Not yet, right? This market's getting really ahead of itself. What you're seeing is a massive compression in term premium, which is very interesting to me because that's not something you typically see at this point in the cycle.
That was Gennady Goldberg, TD Securities head of U.S. rate strategy, pointing out what Tom's been mentioning throughout the morning, which is the real yields, that sort of spread compression and that idea that we're really seeing that move in yield space having to do with that, which has been underpinning a lot of the risk-on feel that we feel throughout the market.
And the risk-on feel, and Mohammed El-Arian featured that early this morning, London time. You see, he thinks he's up early, but he's really only getting out of bed at like 10 a.m. It's like a, professorial thing.
It's like people in D.C. get up too late. People in London are just faking it because they're actually getting,
Try to get breakfast before lunch. But the answer is Dr. El-Arian said, look, it's a risk-on feel. And even with a pullback this morning, Lisa, it's negative 23 on futures, down 0.5%. The risk-on feel endures.
Chillax. That's sort of what we heard this morning from Jim Dwyer. I did want to take a look at a couple stocks that we've been talking about throughout the morning. The tie-up potentially between Hawaiian and Alaskan Airlines, sending Hawaiian Holdings up 181%. I love quoting this in percent, considering that it's up $8.79. So we're talking about $13.65 for the share price. We heard from Helene Becker earlier is that when the share price falls that low, it basically is a signal that it is not a viable airline unless it ties up with somebody else.
And she made clear she sees a regulatory distinction between this and JetBlue and others out there, and that this is, it's not T-Swings, but these are smaller entities, including the acquirer.
Although she did say, by the logic, that they should approve both of this merger, they should also approve the Spirit and JetBlue one. I also wanted to point out Spotify, which I know is your favorite company in the whole world, but I did want to just point out, I do think it's interesting that the shares are up 6.4% after announcing almost a fifth of their workforce will be laid off. Cutting office space. Just a real question around whether this is a specific story or whether there are some broader implications the way that they tried to signal.
I don't know what it means other than it's about streaming and the rest. I think that Warner Discovery is trying to sell a movie music catalog to somebody and can't get it done because the valuations have changed, and that's all this mix of Apple Music, Tidal, Spotify, and the rest. Is it a money-making business? And that's really the arch debate into next year.
How much can you get people to actually pay? I want to pick up on what Gennady Goldberg was saying of TD Securities last week, where he said it just seems like people have gotten a little ahead of themselves. Peter Scheer talking about similarly November as an incredible year, head of macro strategy at Academy Securities, an incredible year that may or may not be repeatable in the coming year, that is December. How much do you lean against some of the moves that we saw last week, Pete?
So one, I'm starting to lean against treasuries a little bit. I think 420 is a little bit too low given the data. I don't like the fact that either 10-year real yields are right around 2% or five-year break evens are back to right around 2%. And if last month's Fed meeting was really about the market had done the work for the Fed, this month's meeting is going to be about, well, the market undid all that work. So I think rates have got ahead of themselves. On the equity side of things, I think we've seen for the last couple of weeks this move where the Russell 2000 disruptive stocks have outperformed some of the broad indices. And I think that actually continues into year end.
Peter, you're so good at use of cash, and I want to go to the use of cash right now of one Mr. and Mrs. Zuckerberg. Bloomberg reporting on the sale of the Zuckerbergs, of a very large amount of Facebook shares. It's a little bit smaller than what Peter Scheer has in Meta, if you will, but they are out right now with some news on that. And Peter, I think this does get to use of cash. It gets to dividend increase. It gets to share buyback, and maybe executives unloading their stock after, in this case, 172% surge. Peter, help me here with where we are in use of cash if we see people like the Zuckerbergs selling shares.
Listen, I think we've had this phenomenal run in the Magnificent Seven. The leadership has been very narrow all year. People have been talking about that. And since November 9th, and we brought up, I think, last week, NVIDIA earnings were very telling as well. NVIDIA earnings were probably fine. Stock went down, but markets rallied. And I'm really looking, the disruptive stocks are doing well. You see Spotify up there today for various reasons. I think you're going to see regional banks continue to do well, commercial real estate, Russell 2000, all the small caps, all the things that people have left behind. As people are trying to figure out where do I put my cash right now, especially if you missed 5% on the 10-year, those kind of look interesting. I think have some momentum coming into year end.
I'm actually fascinated, Peter. Let's meld the two together. I mean, are we going to see bond issuance to support equity ownership? I mean, whether it's the miracle of Zuckerberg's and Facebook up, Meta up is well. I mean, I think it's almost a jumble into next year.
Yeah, I think we are going to see more bond issuance. If we've been certainly talking to some of our corporate issuers recommending that they get out ahead of this, right? We were at 5% on 10 years. We're at 4.2%. You can save some money there. Credit spreads have actually done very well. We're at the lowest spreads all year. So issue some bonds, support your equity. Also, I think we could see some M&A activity finally start picking up. It's been, looked at the end of the summer, you might get a bit of that. But now you've had the stability reasonably long enough. I think you get some interesting transactions done coming into the new year.
A phrase from 12 months ago, and Lisa, I give you, you coined this. It's almost a toxic brew of risk on is where we are.
Which is the reason why a lot of people might say it might have gone too fast, but it's hard to lean against. Peter, just to Tom's point, the news is that Mark Zuckerberg is selling Meta stock for the first time in 2 years. And this comes after the incredible run up, and you're seeing the shares in pre-market trading down about 1.5% on Meta. It raises this larger question of what do you lean against? You said you think Treasuries rates have gone too far. A lot of people, I think, are starting to pick that up, which is maybe why you're seeing a bit of a retracement today. On the equity side, are you hearing anyone lean against some of the tech names that have gone incredibly far so far this year, and frankly, the year that was November?
I'm not sure if many people are actually leaning against them. I think it's still a fairly crowded trade to be long those, but I would be very comfortable being short QQQ, so the NASDAQ 100 versus long IWM, the Russell 2000. I think trades like that are actually well positioned for the next few weeks. And at some point, I do think we probably want to turn bearish on this market. Maybe we get to 4650 on the S&P. Maybe the Russell 2000 can run another 5%. But if the economic data starts coming in as weak as probably needs to be to support 420 10 years, then I think equities are going to roll over a little bit. But that's probably not this week, next week. That's probably closer to the end of year, early January.
So how would Russell 2000 outperform NASDAQ in that scenario, right? Because at this point, if you start thinking about weaker economic growth that supports the bond call, why then would some of the most levered to the economy companies, the smaller companies, do the best?
Because I think people have been avoiding those stocks all year long and crowded into the other stocks. So it's all going to be about what's crowded, right? And if you start getting nervous about the economy, people are going to turn around and say, oh, we got to cut our risk. Well, guess what? If you don't own a lot of Russell 2000, you can't sell the Russell 2000. So you're going to wind up selling what you have. And I think that's just the nature of this market right now. That's the crowded trade. That's where people piled into. So if we get nervous about the economy, that's actually going to sell off harder because that's where people are overweight.
Peter, where's 60-40 12 months from now?
No, probably where it's always been. It's kind of has this attraction. That's one of the things that kind of just keeps on going, along with covered call writing. People like those strategies. I think you want to be probably underweight treasuries right now on that 60-40. You want to be more towards the front end because I think the next move should be slightly higher in yields back to 440 maybe on 10-year. But you still want to play around that. You want these balanced portfolios, and you want to also see what can we do outside. I actually, for the first time in multiple years, for the last 2 weeks, and it hasn't been working yet, I like Chinese stocks more on a trade. I think long-term, I don't want to invest in China, but for a trade, they're fair.
Peter, thank you so much for the comments, particularly there on Meta as the Zuckerbergs unload stock as well. Nobody's talking about use of cash. 12 months ago, it was religion. 24 months ago, it was gospel. Everybody talked about it. And to me, this use of cash in the different ways it can move, what CEOs do, what principal owners do, what companies decide to do with the cash that's out there, I think is underplayed right now.
Are you talking about corporate investment or are you talking about individuals?
Both individuals. Bond issuance. I'm fascinated to see if Magnificent Seven finally do mega gajillion dollar bond issuance again. I just don't know if we're going to see it. But there's the Zuckerberg stepping in after what? Up 172%?
Yeah, 2 years. 2 years since he sold stock.
And that's a rounding error. That's out of the piggy bank, right?
Well, so this raises this question. Does he see something that we don't? Which is maybe why you're seeing Meta shares down by almost 2% now after this news was released in pre-market trading. Perhaps people scenting, maybe he thinks it's a good time to cash out. I mean, otherwise, what would really spur such a significant move?
We'll have much more on that. Look to Bloomberg Technology on Bloomberg. Edward Ludlow, Caroline Hyde as well for further discussion of this news on the Zuckerbergs and their selling of Meta stock. Futures negative 24, the VIX 13.39. Friday, jobs day. This is Bloomberg. Good morning.